Introduction: A gateway into the world of investment. Purpose of the book: a beacon for beginners. At its core, this book is written for one purpose: to help you make money wisely and confidently. But not just any money. Money earned through understanding, not guesswork. Many investment books dive into complex topics right away, assuming the reader already knows basic financial terms, concepts, and tools. But this book starts from zero. It holds your hand and guides you like a mentor would if you were completely new to the world of investing. The author explicitly states, "This book is what they wish they had when they first started. It is designed to save you time and money, while also empowering you with real-world understanding." Learning from mistakes, but smarter. Traditionally, people learn investing the hard way. Trial and error. Losing money in the markets. Gradually learning from their mistakes. This is like learning to drive by crashing into things. Others try to avoid this pain by handing their money over to financial advisors immediately, without knowing how to evaluate them. This, too, is risky. You might be giving your money to someone unqualified or even dishonest just because they sounded confident. The message here is simple yet profound. Experience is valuable, but preparation is better. If you learn before acting, you can avoid major financial scars. Math anxiety, a common obstacle. The author recognizes a hidden fear many beginners have: math anxiety. They acknowledge that words like interest rates, compound returns, yields, and bonds can send shivers down the spine of anyone who has struggled with numbers. But here's the reassurance. The math used in this book is basic, practical, and explained in real-life terms. Even people with severe math phobia have successfully understood the concepts because the language is gentle and non-intimidating. The goal is not to turn you into a mathematician, but into an informed decision-maker. Empowerment through understanding. This isn't just about building your bank account. It's about building your confidence and identity as someone who understands money, understands financial systems, can make independent decisions about their future. The author wants you to feel empowered, capable, in control. Even if math has failed you before, this book aims to reset your relationship with numbers, turning fear into curiosity and confusion into clarity. A language like any other. Learning investing is like learning a new language. At first, it seems like a confusing blur of unfamiliar words. But with a step-by-step approach, even a complex field becomes manageable. In contrast to language textbooks, however, the world of investment has lacked a truly beginner-friendly guide. You're bombarded with books, newsletters, YouTube videos, sales pitches, financial influencers, and worse, smooth-talking salesmen who benefit from your ignorance. This book aims to cut through the noise. It tells you what to look for, what to avoid, where to get quality information, and how to evaluate the people who want to help you with your money. Finding your path in investing. Investing is not just about numbers, it's also about personality. Are you someone who likes hands-on involvement, like owning and managing rental properties? Or do you prefer passive growth, letting your investments quietly work in the background? This book helps you explore your natural temperament. What suits your goals, your energy, your lifestyle? Instead of chasing the highest return, it teaches you to ask, does this investment fit me? Do I enjoy managing it? Can I handle its ups and downs emotionally? Focus on the stock market with flexibility. While the book covers various types of investment, real estate, bonds, mutual funds, etc., it pays special attention to the stock market because it's the most popular investment arena for new investors. It's highly accessible. You can buy shares with just a smartphone. It teaches lessons about risk, timing, and strategy that apply across all investment types. However, the author warns, don't follow the crowd blindly. Explore what you are drawn to. Tools, not overload. At the end of each chapter, you'll find resources, moral, summary, but only the best ones. The author has deliberately limited the list to avoid overwhelming you. Less is more when it comes to learning effectively. This is a book that respects your time and mental energy. It's okay to hand things over wisely. After learning, you might still decide, I don't enjoy managing money. I'd rather hire someone to do it. That's fine, but now you'll be in a position to choose the right financial manager. Monitor your portfolio intelligently. Avoid stories like that of Richard Bach, who lost his fortune and owed the IRS millions because he blindly trusted a friend. The core idea is, even if you outsource, you must understand enough to supervise. Structure of the book. Designed for real progress. The book is divided into 3 clear parts. Part 1. The basics. The essential foundation every investor needs. Written with absolute beginners in mind. Designed to give you a solid mental framework. Part 2. Intermediate strategies. Applies the foundational concepts to real investing. Teaches how to evaluate opportunities, reduce risk, and plan for long-term goals. Part 3. High-risk investments. Introduces the riskier side of the market, commodities, options, etc. Helps you recognize red flags and avoid scams or hype. Shows how experienced investors manage such assets. The structure is logical and cumulative. You build knowledge layer by layer, like learning grammar in a new language. Final message. Investment is both rational and emotional. The world of investment is a mixture of logic, math, analysis, fundamentals, emotion, fear, greed, excitement, impatience. This book teaches you how to navigate both. With clarity, with control, with confidence. As you progress, you'll not only understand financial markets, but you'll also understand yourself better as an investor. Summary. Key takeaways. Start from scratch. No prior knowledge needed. Avoid trial and error. Learn before losing. Math is minimal and friendly. You can do this. Confidence building. You'll feel more empowered. Don't trust blindly. Learn how to evaluate advisors. You are unique. Choose investments that fit your personality. The book is structured to build your knowledge gradually. Even if you hire help, understanding is essential. Resources provided are high quality and selective. Learning about investing is like learning a new language, and this book is your best teacher. The first book of investing, The Absolute Beginner's Guide to Building Wealth Safely. This book is a comprehensive yet accessible guide for anyone who wants to learn how to invest safely, wisely, and effectively. It takes readers from the basics of investment to advanced, high-risk strategies, helping them build confidence and competence at each stage. Part 1. An Overview for Beginners. Part 2. Intermediate Investing. Part 3. High-Risk Investing. Overall goal of the book: to guide readers safely through the entire spectrum of investing, starting from the basics, gaining intermediate knowledge, and finally understanding complex, high-risk opportunities so they can make informed, confident, and personalized financial decisions. Part 1. An Overview for Beginners. This section introduces the fundamental concepts of investing, including what investing is, why it's important, and how to get started. It explains basic financial instruments like stocks, bonds, and mutual funds in simple language. Purpose: to give absolute beginners a solid foundation and help them overcome fear, confusion, and myths around investing. It builds the groundwork for responsible and informed financial decision-making. Chapter 1. The World of Investment. A Deep Dive. Introduction. What do you want from investing? Before embarking on any financial journey, it's crucial to ask a deceptively simple question. What do I truly want from investing? Are you someone who thrives on excitement, unpredictability, and rapid action? Do you envision investing as a kind of high-stakes adventure one that brings to mind roaring stock exchanges, sudden windfalls, and intense risk? If so, you might find your place in the world of trading or speculation. On the other hand, perhaps you're drawn to a calmer, steadier route, taking a scenic train ride through the landscape of financial growth, enjoying moderate yet predictable returns over time. If that resonates with you, then you're more likely to be an investor in the traditional sense. This chapter serves as the gateway into the world of investment. It is a complex, dynamic, and sometimes paradoxical domain where dreams of wealth coexist with real risks, and where knowledge, discipline, and self-awareness become your most valuable assets. Traders versus investors. Understanding the difference. A key distinction to understand at the outset is the one between trading and investing, two activities that may seem similar but are philosophically and practically worlds apart. Traders are primarily concerned with price movement over short periods of time. Their game is timing, buying low, selling high, often within hours, days, or weeks. Their primary goal is quick profit, and they focus on market signals, price charts, and technical analysis rather than the underlying health of a company or asset. Example: a trader buys IBM stock because they believe it's about to spike, based on a short-term technical pattern. Once it rises, they sell, pocketing the quick gain. Investors, in contrast, look beyond short-term fluctuations and concentrate on long-term value. They analyze a company's business model, profitability, leadership, and competitive position. Investors believe in the intrinsic strength of the asset and are willing to wait years to realize growth. Example: an investor buys IBM because they believe it will grow steadily over the next 5 to 10 years. They are less concerned with today's price swings. This foundational divide is essential because it shapes everything from your mindset to your strategy and even your emotional resilience during market turbulence. Speculation versus investing. Learning to read the fine print. In today's world, you'll often encounter advertisements for investments that promise high returns with little risk. These should be approached with caution. Often, what is marketed as an investment is actually a speculation, or worse, a gamble disguised in fancy language. So what's the difference? Investing means placing your money in vehicles that are expected to grow steadily over time, with reasonable levels of risk and reward. Investments are chosen based on informed decisions, and the intention is typically long-term. Speculation involves taking higher risks in the hope of higher returns. It's more opportunistic and often shorter term. While experienced speculators may do well, they operate in a less predictable environment, often using insider knowledge or advanced analysis. Gambling, by contrast, is pure chance. It's risking money without the necessary understanding, preparation, or control. Investing in stocks or cryptocurrencies without any real knowledge is not investing or even speculating. It's gambling. What might be speculation for a seasoned market analyst could be gambling for a novice. Risk and reward, the eternal trade-off. Every investment involves a balance between risk and reward, often illustrated using risk-reward thermometers. Here's how this works. Investments like small company stocks may offer high rewards, but they also come with high risks. The company might grow exponentially, or it might fail. On the other hand, government bonds offer low risk, but also lower returns. They are considered among the safest places to store money, especially for conservative investors. This trade-off is non-negotiable. In the investment world, you don't get high returns without accepting higher risk. Trying to chase high rewards with zero risk is the hallmark of either a scam or wishful thinking. The savvy investor learns not to fight this principle, but to work within it. Navigating uncertainty. Giving up the illusion of certainty. A critical lesson for any new investor is this: there are no guarantees in investing. The markets are shaped by complex, interlocking factors: economic shifts, global events, consumer psychology, interest rates, technological disruption, and more. What worked brilliantly last year may fail this year due to reasons no one could predict. Even seasoned advisors and analysts disagree. Three professionals, presented with the same set of market data, may give you three completely different opinions: bullish, bearish, or neutral. In market lingo, a bull believes the market is rising. A bear believes the market is about to fall. The financial media may show a bull-bear ratio of expert opinions, but in practice, these forecasts often cancel each other out. In short, there is no crystal ball, but that doesn't mean we're helpless. Instead of chasing predictions, wise investors focus on minimizing risk, diversifying assets, and maintaining a disciplined strategy. 3 modes of handling money: invest, speculate, or gamble. Understanding how to handle money involves a fundamental classification. Investing: careful placement of funds into assets, like stocks, bonds, or real estate, with an expectation of steady returns. The emphasis is on preservation of capital, stability, and long-term growth. Speculating: riskier ventures, usually undertaken by those who understand specific markets well, like commodities, options, or crypto, hoping for short-term gain. Gambling: engaging in financial actions with little to no knowledge and very high risk, relying on chance. Without preparation, even speculating becomes gambling. Remember, if you're a beginner, you're playing against professionals. Without knowledge, you're not just gambling. You're gambling with the odds stacked against you. The golden rule of investing: past performance, future success. Above the metaphorical gateway to investing is engraved one eternal truth. Past performance is no guarantee of future success. This is not just legal fine print. It is the heart of investment wisdom. Markets evolve, economies shift, and no strategy remains foolproof forever. Instead of relying on past trends, successful investors learn to analyze current fundamentals, adapt, and diversify. Know thyself. What kind of investor will you be? Before selecting your first investment, it's essential to answer: are you conservative by nature, preferring stability? Or are you comfortable with moderate risks for higher rewards? Do you want to invest for retirement, a child's education, or simply to grow your wealth over time? Are you seeking income, capital appreciation, or both? Your personal comfort with risk, your time horizon, and your financial goals will define your investment profile. There is no one-size-fits-all solution. The right investment is not what your friend or cousin is into, but what aligns with your own temperament and goals. Skill versus instinct. Investing requires learning. Don't make the mistake of thinking success in your job or profession automatically translates to investment success. Investing is a learned skill, not an innate talent. Just as you once learned your trade, you will need to study market principles, understand financial instruments, stay informed about the economy, develop emotional discipline. You are not just working for money anymore. You are learning to make your money work for you. Start with preparation, not emotion. If you've recently come into money, perhaps through inheritance, bonuses, or retirement, it's tempting to jump in quickly. But emotional decisions often lead to poor investments. Give yourself time to reflect on your goals, educate yourself, seek advice from reliable sources, start small, and learn by doing. Conclusion: onward into the world of investment. Investing is not a guaranteed path to riches, but it can be one of the most powerful tools for building long-term wealth. It rewards the prepared, the patient, and the informed. The rest of this journey will equip you with tools to understand different asset classes, assess risk realistically, avoid common pitfalls, design a strategy that fits you. So begin your journey with eyes wide open, mind sharp, and goals clearly in sight. The world of investment awaits. Moral lessons from Chapter 1. The world of investment. Know your purpose. Understand why you're investing, whether it's for retirement, education, income, or wealth building. Distinguish between trading, speculating, and investing. Trading is short-term and price-focused. Speculation involves risk and informed guesses. Investing is long-term, value-based, and disciplined. Risk and reward. go hand in hand. High returns usually come with high risks. Safer investments typically yield lower returns. Beware of too good to be true offers. Many flashy investments are actually risky speculations or outright scams. There are no guarantees. Past performance doesn't predict future success. Markets are uncertain and constantly changing. Educate yourself before you invest. Success in investing requires learning and discipline, not luck or emotion. Gambling is not investing. Without knowledge and strategy, even stock market activity becomes gambling. Understand and accept market volatility. Price fluctuations are normal. Real investors don't panic with every market dip. Know your risk tolerance. Choose investments based on how much uncertainty and loss you're comfortable with. Be patient and long-term focused. Building wealth takes time. Don't expect overnight riches. Don't rely blindly on experts. Even professionals often disagree. Use their advice, but make your own informed decisions. Use resources wisely. Think before you act on sudden wealth. If you've recently come into money, take time to plan before investing emotionally or impulsively. Your money should work for you. Investing is about using money intelligently to create more money over time. Chapter 2. Dealing with Money Consciously. A Journey Within. When we think about investing, we tend to focus almost exclusively on the destination: financial freedom, security, wealth accumulation. But too often we overlook the starting point, our inner relationship with money. This chapter invites us to shift our perspective from merely how to invest to why and how we feel about investing in the first place. Because unless we understand the psychological and emotional layers behind our financial behavior, we may unconsciously let our feelings drive our decisions instead of sound strategy. Money, it turns out, is not just a tool or a resource. It is also a mirror reflecting our self-worth, our fears, our upbringing, and even our unspoken beliefs about power, success, and identity. If we don't address this internal landscape, even the best financial advice may fall flat or lead us astray. 1. The psychological origins of our money attitudes. A. Family influence, the silent curriculum. From childhood, we are quietly taught what money means. Whether you grew up in a wealthy, middle-income, or low-income home, you were handed a set of unspoken financial values. In many families, money is a taboo topic, not openly discussed, even when its presence or absence shapes everything. In wealthy families, there may be guilt or discomfort about privilege. Children might be taught not to flaunt their wealth, yet also not taught how to manage it wisely. In low-income families, the lessons may be shaped by scarcity, stress, or even shame. Financial survival might overshadow any talk of investing or building wealth. In middle-income households, the messaging may be ambiguous, ambitious but anxious, hopeful yet cautious. These emotional imprints become unconscious rules that govern how we save, spend, or avoid money. If we don't uncover and challenge them, they will dictate our financial behavior, often in ways that sabotage our long-term goals. B. Cultural silence, why we don't talk about money. Our broader society also contributes to this silence. Schools teach economics at the macro level, but rarely offer guidance in personal financial management. We learn about GDP and trade deficits, but not how to budget, invest, or plan for retirement. The result? A culture where talking about money is awkward, even shameful. This silence reinforces two dangerous myths. Money is intuitive, you're either good with it or you're not. Everyone else knows more than you, so don't ask questions. But money is a skill, not a talent. It can be learned at any age, regardless of your starting point. 2. Gendered assumptions and their consequences. A. Men and the myth of mastery. There is a persistent stereotype that men are naturally good with money, bold in risk-taking, and confident in investing. This myth fuels overconfidence, encouraging risky ventures without adequate planning. Because men are taught to view money as a marker of status and competition, they may feel pressured to succeed at all costs and ashamed to admit failure. As a result, they may take on high-risk ventures without proper research, avoid sharing financial setbacks, creating an illusion of success, make investment choices based on ego, not evidence. B. Women and the myth of incompetence. In contrast, women are often socialized to feel unqualified to handle finances. They're taught to budget, not invest, to manage a household, not a portfolio. Yet evidence shows that all female investment clubs tend to outperform all male or mixed groups, because women often take a more measured, goal-oriented approach. Still, many women internalize messages like, "Money is a man's job. I'm just not good at math. It's safer to let someone else handle it." The cost of this underconfidence is enormous, not only financially, but psychologically. It keeps women from claiming their economic agency and full independence. But as attitudes shift, women are increasingly stepping into financial literacy and leadership. The key difference lies in conscious choice. Giving up financial control out of apathy or fear is passive surrender. Delegating with knowledge and oversight is empowered collaboration. 3. The emotional complexities of inheritance. Inheriting money brings not just opportunity, but emotional turbulence. The context of loss, a loved one's death, often colors the experience with guilt, confusion, and a sense of undeserved fortune. Emotions commonly experienced by inheritors include grief. The money reminds them of the person who is gone. Guilt, especially when others around them are struggling. Identity conflict. Suddenly having wealth may challenge a long-held identity of being self-made or financially modest. What should an inheritor do first? Nothing. In the fog of grief, it's best to park the money in a safe, low-risk account and take time to emotionally adjust. Investing decisions should come later, when you are grounded and clear. Some essential first steps. Update or create a will to reflect your new assets. Ensure you have proper insurance coverage. Begin financial planning slowly, with advice from qualified professionals. Consider therapy or counseling to work through emotional roadblocks. Remember, wealth is a form of power. Accepting it means accepting the ability and responsibility to shape your future, and possibly contribute meaningfully to others' lives. 4. Sudden wealth from lotteries or windfalls. Winning the lottery may seem like pure joy, but it brings its own set of challenges. Loss of friendships due to envy or distance. Pressure to give or lend money. Temptation to spend lavishly. Disorientation from sudden lifestyle changes. Again, the best advice is to do nothing at first. Let the reality sink in. Resist impulsive decisions. Consult a financial advisor. Reflect on your values and goals. If you receive winnings in installments, as is often the case, you can still build long-term wealth by investing part of each payment. For instance, setting aside a fraction of your yearly payout can compound into millions over 2 decades. Money that arrives like a dream must be handled with the clarity of someone fully awake. 5. Money as a mirror and a tool for growth. Whether your wealth comes slowly through saving or suddenly through luck, the most important question is, what do you want your money to do for you? Not just, what can I buy? But, how can I grow? What impact do I want to make? What legacy do I want to leave? For those who have struggled financially, investing in oneself through education, skill building, or starting a business can be transformational. For others, philanthropy becomes a meaningful way to use money as a force for good. 6. When emotional blocks interfere. If you know the basics of money management but still overspend, avoid finances, feel anxious or guilty, gamble or over-risk, then the issue may be emotional, not educational. Money issues often serve as proxies for deeper psychological conflicts about worthiness, control, freedom, or love. In such cases, counseling or therapy can be an invaluable investment. Financial conflict is also one of the top causes of strain in relationships. Understanding your own and your partner's money psychology can unlock deeper harmony. 7. The conscious money game. Stuart Wilde's idea in The Trick to Money is Having Some is profound. Money is not just a game with the outside world, it's a game we play within ourselves. To win this game consciously, know your origins, your financial upbringing, and its effects. Examine your emotions around wealth, scarcity, and power. Clarify your goals and how money fits into them. Learn steadily investing is a skill, not a mystery. Act deliberately. Let every decision be a reflection of awareness, not fear. Final thoughts. Own your power. Money may not buy happiness, but consciousness about money can. By learning to understand your financial self, your beliefs, habits, fears, and hopes, you begin to claim power over your destiny. You stop reacting and start responding. You stop following and start leading. Money, in the end, is not the goal. It's a tool, a mirror, a path. When you deal with it consciously, it becomes not just a source of wealth, but a source of growth, freedom, and self-realization. Core morals and lessons. Self-awareness is the foundation of wise investing. Your past experiences, emotions, and beliefs about money strongly influence your financial decisions. Becoming aware of these inner forces is essential before making any investment. Your family background shapes your financial mindset. Whether rich, poor, or middle class, everyone inherits psychological attitudes toward money from their upbringing. Understanding and challenging these can free you from unconscious limitations. Money is often a taboo topic, but must be talked about. Since many families and schools avoid open discussions on personal finance, it's crucial to take responsibility for learning and developing your own financial literacy. Men often suffer from overconfidence, women from underconfidence. Gender stereotypes distort financial behavior. Men may take uncalculated risks, while women may give up control due to false beliefs about incompetence. Both attitudes can be corrected with education and awareness. Delegating money management is okay if it's a conscious choice. It's fine to let someone else manage your investments if it's done from a place of knowledge, not fear. Passive surrender is different from informed delegation. Inheriting money brings emotional baggage. Grief, guilt, and identity conflicts are common. Don't rush into investing, take time to emotionally process and plan mindfully. Do nothing rash with sudden wealth, lottery, inheritance. Let the money sit safely at first. Avoid impulsive decisions. Let emotions settle before making plans. Hold on to capital invest for income and growth. Spending your capital kills your future income potential. Invest the principal and spend only the income it generates. Money brings power and responsibility. Whether inherited or won, money gives you new opportunities. Use it to enhance your life and possibly help others, not to escape emotional discomfort. Guilt or unworthiness can cause financial self-sabotage. If you feel you don't deserve wealth, you may unconsciously lose it. Therapy or counseling can help resolve these internal conflicts. Emotional maturity is key to financial success. Even after learning financial strategies, unresolved emotions can lead to overspending, anxiety, or risky decisions. Inner work is often more important than external advice. Money disputes in relationships often reflect deeper issues. Understanding each other's financial background and motivations can help couples avoid chronic conflict and build financial harmony. Investing in yourself brings the highest return. Use newfound wealth or income to pursue education, skills, or dreams. This creates long-term personal and financial growth. Philanthropy can heal emotional tensions around wealth. Giving back, even in modest ways, can help resolve guilt and create a deeper sense of purpose. Conscious money management is a form of personal empowerment. Being mindful and intentional with money is not just a financial act. It's a declaration of self-worth and power. Money is a game you play with yourself, not just the market. The real investment challenge is internal. Winning means mastering your thoughts, emotions, and attitudes, not just beating the market. Chapter 3. Personal Finance. The Foundation. Investment begins at home. At first glance, personal finance may seem unrelated to investing. But the core principle of this chapter is this: your personal financial habits, choices, and systems are the very soil in which your investments grow. Even the best investment decisions are fragile and meaningless if your personal finances are in disarray. Bill Donahue's comment about paying off credit card debt yielding 15–20% might have triggered laughter, but the underlying truth is mathematically unshakable and financially profound. Paying off a debt that charges 18.5% interest is effectively the same as earning 18.5% on an investment without risk. Most people focus on earning more, but this chapter turns our attention to spending smarter and eliminating inefficiency. Why chase 15% returns in volatile markets when you're simultaneously bleeding money in interest payments, late fees, or insurance oversights? Lesson: personal finance and investing are inseparable. Suppose you invest $10,000 and earn a 15% return, $500 gain. But if during that same year you pay $1,850 in credit card interest, you're still net negative by $350. This is a clear illustration that ignoring personal finances can silently erode even your smartest investments. This realization leads us to a bigger truth. Managing your money wisely is itself a high-return investment. Money and emotions, the hidden forces. Money is not just numbers and logic. It's deeply emotional. Most people aren't taught how to manage money. They react to it emotionally, whether by impulsive spending, fear-driven hoarding, or financial procrastination. Changing financial habits isn't about raw willpower. You must confront your emotional relationship with money. Why do you overspend? Do you buy things to feel temporarily better? Are you using money to mask deeper dissatisfaction? Joe Dominguez's seminar and book Your Money or Your Life is recommended as a tool for this emotional financial reprogramming. The key idea is that money, life energy. When you spend wastefully, you're not just losing money, you're losing pieces of your life. What you must review: the 7 pillars of personal finance. To be truly ready for investing, you must first build a resilient and organized personal finance system. These are the areas to review and fortify. 1. Money management. Do you track your spending? Do you budget monthly or live in financial fog? Are you paying fees that could be avoided? Keeping a balanced checkbook and a clear budget is the bedrock of financial stability. 2. Personal financial statement. What do you own? Assets. What do you owe? Liabilities. This document gives you a real-time snapshot of your net worth and helps you track progress toward financial goals. 3. Insurance. Do you have adequate coverage? Health, life, auto, property. Will your family be financially protected if disaster strikes? Insurance isn't just about protection, it's about preserving your financial base. 4. Financial goals. What are you working toward? Are your goals aligned with your spouse or family? Clarity of goals helps you prioritize financial actions and avoid distractions. 5. Taxes. Do you pay only what's due or more? Are you missing deductions? A good tax advisor or personal education can mean thousands in savings annually. 6. Debt. Are you carrying expensive debt? Would missing one paycheck destabilize your life? Reducing or eliminating debt provides financial freedom and psychological peace. 7. Retirement planning. Are you saving early and consistently? Do you understand the power of compound interest? Starting early, even with small amounts, creates exponential growth over time. Help. Education and help. Don't go it alone. The chapter encourages the use of books, seminars, and, if needed, professional financial planners. Personal finance isn't common knowledge. It's a skill set you develop intentionally. Educating yourself creates a feedback loop of empowerment. The more you know, the better your decisions, and the faster your progress. Taxes. Keep what you earn. Investment success isn't just about making money, it's about keeping more of it. Understanding how to minimize taxes legally can increase your real returns significantly. The chapter stresses that, even if you hire a tax advisor, you should still understand the basics. Knowing tax rules about gains, losses, deductions, retirement contributions, and capital gains gives you a strategic advantage. Wills. Plan for the end, so life can continue. Death is inevitable, but disorder and legal chaos afterward are optional. Without a will, or with a legally weak will, you leave your family vulnerable. You hand control to the court. Your estate can be eaten by legal fees. Get a legally solid will and store it securely. If you have kids, designate guardians. If you want to give to charity, be explicit. Also, keep your spouse or heirs informed. Organize your financial records for them. Use tools like personal financial organizers and write down instructions. If something happens to you, organization is protection. A powerful story in the chapter tells of a woman who believed she was nearly broke after her husband's death, only to discover he had $300,000 in disorganized assets hidden in a chaotic office. The moral? Information that isn't accessible is as good as lost. So, involve your spouse or trusted family in your finances. Leave behind clearly documented portfolios, instructions, and asset locations. Note the location of your will and important papers. Recommended resources. The chapter ends with a goldmine of practical, readable books that guide you on specific areas. Your money or your life. On emotional money habits and redefining your financial values. Straight talk on money. Clear answers to common personal finance questions. The Guide to Tax-Saving Investing. Practical tax strategies for investors. How to get out of debt. A step-by-step recovery plan for those overwhelmed by debt. Final takeaway. Personal finance is the precondition for investing. This chapter teaches us a crucial truth. Before you build wealth, build your foundation. Trying to invest without mastering your personal finances is like planting a garden in sand. You must organize, plan, protect, and understand your money before you can expect it to grow reliably through investment. Morals of the chapter. Eliminating debt is one of the highest return investments you can make. Personal finance and investing are two sides of the same coin. Emotional awareness is critical. Money issues often reflect deeper psychological patterns. A strong personal finance structure includes budgeting, insurance, retirement planning, and wills. Tax knowledge amplifies your real investment returns. Financial disorganization can erase decades of good work. Order is power. Leaving your loved ones uninformed or unprotected is financially and emotionally irresponsible. Start learning. Keep learning. Good resources and good advisors are your allies. Chapter 4. The Stock Market. The Birth of a Company and the Need for Capital. Imagine you are an entrepreneur with a powerful idea, say, designing eco-friendly electric bikes. To bring this idea to life, you need to build factories, buy raw materials, and hire skilled workers. All of this requires money capital. But where do you get it? There are three main ways to raise capital. Self-financing, using your own savings or profits. This keeps control in your hands but limits how fast you can grow. Borrowing, taking loans from banks or individuals. This allows access to large sums but requires repayment with interest. Selling ownership. Equity. You can invite others to share ownership by issuing stocks. In return for their money, they get a piece of your business. This third method, selling shares, is where the stock market comes in. Bonds versus stocks, two faces of investment. When companies borrow from individuals rather than banks, they issue bonds. These are formal agreements to repay borrowed money after a fixed period with regular interest payments along the way. But when companies sell stocks, they are not borrowing. They are giving away partial ownership of the business in exchange for capital. Stockholders are not lenders. They are co-owners. Their return depends on how well the business does. If it profits, they may get dividends. If it grows, their stock price may rise. Public versus private, the transformation. Once you issue stock to the public, your company becomes a publicly held corporation. This means anyone can buy a piece of your company. You must disclose financial information. You are accountable to shareholders. Not all companies choose this route. Some remain privately held, owned by a few individuals or families. But for many businesses, going public is the gateway to rapid expansion and global presence. The role of investment bankers. When companies decide to raise money by issuing stocks or bonds, they turn to investment bankers. These professionals help determine how much money should be raised, set a fair price for the stock, promote the offering to investors, underwrite the risk, i.e., buy the stock themselves and sell it to others. They act as bridges between companies and investors, and they are central to the modern capital markets. A historical perspective. From coffeehouses to global exchanges, the roots of stock trading stretch back to the late Middle Ages. Early forms of investment involved handwritten certificates. By the 1600s and 1700s, wealthy merchants began buying shares in trading companies like the British East India Company. These shares were traded informally in coffeehouses and parks. Gradually, as more people joined in, formal stock exchanges were born. The New York Stock Exchange, NYSE, began in 1792 under a buttonwood tree on Wall Street. Over time, it evolved into the giant financial institution we know today. How are stocks traded? Then and now. Stock trading remains essentially an auction-based process. Buyers bid the maximum they're willing to pay. Sellers ask the minimum they're willing to accept. A trade happens when these prices match. The NYSE operates from a massive trading floor in New York, where floor brokers and specialists execute large trades. But today, most trading is electronic. Computers match buyers and sellers in milliseconds. NASDAQ introduced a revolutionary idea, a decentralized computer-based system that allowed brokers to trade over-the-counter, OTC stocks, without a central trading floor. This made trading faster, cheaper, and more accessible. Understanding the stock market ecosystem. There are multiple tiers and types of stock markets. New York Stock Exchange, NYSE, home to over 2,000 large established companies. American Stock Exchange, AMEX, hosts about 1,000 stocks, generally smaller than NYSE. Regional exchanges, smaller U.S. exchanges handling local or regional companies. NASDAQ, over 3,000 actively traded tech and growth-oriented companies. Pink sheets and OTC markets. Very small companies, often speculative and risky. Each market has different listing requirements. Financial thresholds companies must meet to be traded there. The bigger the company, the more likely it will be listed on NYSE or NASDAQ. Who owns the market? Ownership of stocks isn't limited to individuals. In fact, institutional investors, like pension funds, university endowments, mutual funds, and even foreign governments, own about 40% of the stock market. These players can move markets with large trades and often influence corporate decisions. The secondary market, pre-owned stocks. When you buy stocks, you are usually buying them from another investor, not the company. This is the secondary market, like buying a used car with a new title in your name. The only time a company receives money is when it sells new shares, a new stock issuance or IPO. Even if you get a fresh stock certificate with your name on it, the underlying shares are pre-owned. Types of stocks. Something for everyone. The stock market offers a rich variety of stocks catering to different investor needs. Blue-chip stocks. Large, stable, and well-established companies like IBM or GE. They are financially strong and offer steady dividends and lower risk. Secondary issues. Slightly smaller but still solid corporations. Less glamorous but often good long-term bets. Income stocks. Known for high and consistent dividend payouts, such as utilities. These are attractive to conservative investors. Growth stocks. Young, dynamic companies with potential for rapid expansion. Dividends are low or non-existent. These stocks are high risk to high reward. Penny stocks. Extremely cheap stocks, often under $5. High volatility and high risk, comparable to gambling. Cyclical stocks. Follow the ups and downs of the economy. Examples include car manufacturers and construction companies. Defensive stocks. Remain stable even during downturns. Think food, utilities, and household products. They offer safety when the economy slows. Dividends. Your share of the profits. Dividends are your portion of a company's profits, paid quarterly or annually. Not all companies pay them. Younger firms often reinvest earnings to grow, but blue chips and utilities tend to pay regular dividends, making them favorites among retirees and conservative investors. Example: if you own 100 shares of GE and the dividend is $0.50 per share per quarter, you earn $100x50 so $50 per quarter, $50x4 or $200 per year. This return called dividend yield might be 2.5% to 5%, depending on stock price. You can even reinvest your dividends automatically to buy more shares, compounding your wealth without paying brokers' fees. How to pick the best stocks. Stock picking is both an art and a science. You have two main choices. Do your own research. Analyze financial statements. Study sales, profits, debt levels, and industry position. Learn about the company's management and vision. Use tools like price-to-earnings ratio, growth rate, dividend history. Rely on professionals. Financial advisors and brokers can provide guidance. Investment newsletters are also a powerful resource. The power of newsletters. Some professionals devote their lives to analyzing companies. They share their insights in investment newsletters, which can be conservative or speculative, focused on growth, value, income, or international stocks. To evaluate them, subscribe to the Holbert Financial Digest, which ranks newsletters by their track records. You can then subscribe to the best-performing ones in your interest areas. Tip: start with a trial subscription and read a few newsletters before committing. But remember, no one has a crystal ball. Even experts with excellent analysis can be wrong. Use their advice as part of a balanced, informed approach. Final thoughts. Investing with wisdom. Success in the stock market requires more than luck. The best investors combine discipline, follow a clear strategy, flexibility, adapt when things change, patience, let your investments grow over time, curiosity, learn constantly. This chapter has laid the foundation. You now understand what stocks are, how markets work, who the players are, and how to approach stock selection wisely. The next steps will build on this by diving deeper into analysis, diversification, and portfolio strategy. Moral lessons from Chapter 4. The Stock Market. Capital is the lifeblood of business. Every business needs capital to grow, and selling stocks is one of the most powerful ways to raise that capital by sharing ownership with investors. Stocks represent ownership, not loans. Buying a stock means becoming a partial owner in a company, not a lender. Your returns come from dividends and stock appreciation, not interest. Stock markets empower growth and participation. Public stock exchanges allow millions of people, including small investors, to participate in the success of companies and the economy. The stock market is a secondary market. Most of the time, you're buying shares from other investors, not directly from the company, meaning stock price increases benefit investors, not the business. Different stocks serve different needs. From blue chips to penny stocks, each type serves a different investment goal, stability, income, or high growth potential. Matching your goals to the stock type is key. Dividends offer income, but not all companies pay them. Only well-established firms typically pay dividends. Young growth companies reinvest their profits instead, offering potential capital gains over income. Risk and reward go hand in hand. Higher returns often come with greater risk. Understanding the risk level of different stock types helps protect your investments. Markets react to perception, not just performance. Stock prices can move due to investor sentiment, economic trends, or world events, not just company performance. Be ready for unpredictability. Research is power. Good investing is built on sound research. Learning how to read financial data and company fundamentals gives you control over your investment decisions. Advisors and newsletters can help, but they're not infallible. Expert advice can guide you, but it's still essential to think critically and make informed decisions for yourself. Consistency beats luck. Successful investing is about patience, discipline, and a long-term view, not chasing short-term wins or market tips. Diversification is essential. Just like different stocks serve different roles, a balanced portfolio should include a mix to reduce risk and improve stability. Investing is a learning journey. The more you observe, read, and engage, the better your instincts become. Over time, you'll become a more confident and capable investor. Chapter 5. Buying and Selling Stocks. 1. Understanding what a stock really is. At its core, a stock is a certificate of ownership. When you buy a share of a company, you are not merely buying a piece of paper or a digital number, you are buying a fraction of that company. This ownership means you are entitled to a portion of the company's profits, dividends. You can benefit if the value of the company rises, capital gains. You assume risk if the company performs poorly, losses in stock price. For example, if you purchase 100 shares of IBM, you're not just investing in a name, you are participating in its success or failure. As IBM innovates, competes, and profits, or loses, your wealth will move in tandem with its fate. 2. The emotional element of ownership. Part of the excitement of buying stocks stems from the psychological satisfaction of ownership. Especially in a country like the U.S., where entrepreneurship and capitalism are deeply embedded in the culture, owning stock taps into the dream of owning a business, even if it's just a small slice of a big company. This emotional connection often leads investors to follow company news more closely, feel personally involved in corporate success or scandal, make emotional decisions, both good and bad, instead of rational ones. 3. Price movements and the law of supply and demand. Stock prices fluctuate according to the simple economic principle of supply and demand. But while the rule is simple, its underlying triggers are highly complex. More buyers than sellers, price goes up. More sellers than buyers, price goes down. However, the real complexity lies in understanding why people buy or sell. These reasons are often not tied directly to the company's actual value. Example: rumors of a revolutionary new computer chip might cause panic selling of IBM stock, even if IBM is secretly developing an equally powerful chip. In such a case, public perception, not reality, drives the price down, creating opportunities for investors with deeper insight. 4. Enter the broker, your middleman to the market. Since individuals can't directly buy and sell stocks on exchanges like the NYSE or NASDAQ, they need intermediaries. These are called stockbrokers. A broker's job is to place buy and sell orders on your behalf, charge a commission for their service. Types of brokers: full-service brokers, e.g., Merrill Lynch, E.F. Hutton, offer investment advice, research, financial planning, charge higher commissions, ideal for beginners or those seeking hand-holding. But beware, many are also salespeople who may push products to earn more commissions. Discount brokers, e.g., Charles Schwab, Fidelity, provide no investment advice, only execute trades. Charge significantly lower fees. Best for independent, self-educated investors. Super discount brokers offer ultra-low commissions, often online or automated. Little to no personalized service. Great for active traders who know what they want. 5. Commission costs and their impact. Commissions matter. Every time you buy or sell, your broker gets paid. Example: buying 100 shares of IBM at 90 to $9,000. Full-service broker might charge $120 commission. Discount broker might charge $60. Commissions are sometimes flat fees or calculated based on share quantity or total transaction value. Typically come with a minimum charge, e.g. $50. Takeaway: over time, frequent trades with high commissions can significantly eat into your investment returns. 6. Choosing the right broker. Choosing a broker is a lot like choosing a doctor or lawyer. It's about trust, competence, and fit. If you want advice and don't mind paying for it, consider full-service brokers. If you're independent, knowledgeable, or on a tight budget, go for a discount broker. Look at track record and reputation, available services, accessibility and responsiveness, commission structure. Don't just fall for titles like financial consultant or account executive. Focus on substance over labels. 7. How to actually buy a stock. The mechanics are straightforward. Open a brokerage account, typically a cash account. Deposit funds into the account. Place your order. For example, buy 100 shares of IBM. Broker confirms the current trading price, e.g., 90.75 a share. You approve. The trade is executed. Your account is debited for the stock price plus commission. You can hold the certificate physically, risky, or let the broker hold it in street name, a safer and more convenient option. The broker will send monthly statements. Keep a running tally of your stock values. 8. Market cycles and emotional shifts. Once you own stock, your perspective changes. You start seeing news differently. Economic booms, you're optimistic. Your stocks may soar. Recessions. Worry sets in, stock prices may tumble. Even if a company is doing well, its stock may still decline if the broader market is down due to recession fears or political uncertainty. Lesson: stocks reflect not only a company's fundamentals, but also investor sentiment, macroeconomic trends, and even global events. You will eventually realize, not every dip is a reason to sell. Not every rally is a reason to buy. Investing requires emotional maturity and discipline, not just technical knowledge. Moral lessons of Chapter 5. Stock ownership equals real ownership. You're buying into a company's future. Market prices are influenced more by perception than reality. Brokers are middlemen. Some are helpful advisors. Others are just salespeople. Understanding broker types helps manage costs and expectations. Commissions can erode profits, especially for frequent traders. Discount brokers are ideal for self-reliant investors. Full-service brokers suit those needing guidance. Choosing the right broker is key. Trust, transparency, and alignment with your goals matter most. Buying and selling stocks is mechanically simple, but the decision-making is complex. Owning stock makes you economically and emotionally invested in the broader economy. Resisting panic or euphoria during market swings is essential for long-term success. Chapter 6. Mutual funds. The challenge for new investors. Complexity versus control. New investors often find themselves torn between two poles. On one side is the desire to take charge of their own financial futures by managing their investments. On the other is the overwhelming complexity of researching and selecting the right stocks, monitoring markets, and managing risk. To bridge this gap, mutual funds offer a third way, a simplified yet professional investment path. What are mutual funds, really? At their core, mutual funds are investment companies. But unlike traditional companies that produce goods or services, mutual funds generate returns by pooling investor money and investing it in portfolios of securities, typically stocks, bonds, or a mix of both. Think of a mutual fund as a professional investor working for you and thousands of others, spreading your risk across many companies and industries. This diversification drastically reduces the impact of any single company's failure, making mutual funds especially attractive to new or cautious investors. How mutual funds work. You buy shares in the fund. When you invest in a mutual fund, you're not buying shares of Apple or Tesla directly. You're buying shares of the fund itself, which in turn owns shares in Apple, Tesla, and hundreds of other companies. The value of your mutual fund shares is tied to the performance of the underlying portfolio. Managed by professionals. Your money is managed by full-time fund managers whose job is to analyze markets and industries, research companies, make buy-sell decisions based on economic trends and financial data. You pay these managers a management fee, but in return, you get expertise and time savings. Diversification, the heart of risk management. Diversification is perhaps the single greatest advantage of mutual funds. One fund may hold 50, 200, or even 400 companies. If one stock crashes, others can balance it out. This creates portfolio resilience, a cushion against volatility. Rather than gambling on one or two stocks, you ride the average performance of many. Popularity and growth of mutual funds. In recent decades, the number of mutual funds has exploded from a few hundred to over 8,000. Assets under management have ballooned into the trillions. Why? Because mutual funds simplify investing for beginners, provide access to professional management, offer customized exposure to nearly every sector, region, and risk profile. Types of mutual funds, matching goals with vehicles. Mutual funds are not all the same. They are tailored to suit various objectives, risk tolerances, and time horizons. General categories. Aggressive growth funds. Focus. Fast-growing companies. High risk, high reward. Minimal dividends. Heavy on capital appreciation. For those seeking rapid gains and willing to tolerate volatility, growth funds. Invest in companies with consistent earnings growth. Moderate risk, long-term focus. Some income through dividends. Growth and income funds. A hybrid of appreciation plus income. Include dividend-paying stocks and convertible bonds, more stable than pure growth funds. Balanced funds. Mix of 60% stocks and 40% bonds, traditionally. Focused on capital preservation and steady income. Ideal for conservative investors. Bond funds. Invest in government or corporate bonds. Offer fixed income and stability, though exposed to interest rate risk. Specialized categories. International funds. Exposure to global markets. Precious metals funds. Invest in gold, silver, and other metals. Volatile. Real estate funds. Invest in REITs or property companies. Sector funds. Technology, healthcare, energy, etc. Socially responsible funds. Align investments with personal ethics. Index funds. Track a specific market index like the S&P 500. How to buy mutual funds. You can invest in mutual funds in two main ways. 1. Through a broker. Convenient but may involve commissions and fees. 2. Directly from the fund company. Often no load and ideal for small investors. Terminology to know. Load. A sales commission or fee charged up front, front end, at the time of sale, back end, or gradually. 12b1 fee. No load fund. A fund with no sales commission, often more cost-effective. Management fee, annual charge 0.5%, 1% for professional management. 12b1 fee, used for marketing or distribution, can eat into returns. NAV, net asset value. The price per share, calculated as NAV, or SAD, total assets, liabilities, number of shares. Outstanding. How returns work. Mutual fund earnings come from dividends paid by stocks in the fund, interest from bonds, capital gains from selling securities at a profit. You can take earnings as cash, reinvest them, a powerful way to compound wealth over time. Regardless, you will pay taxes on earnings whether you reinvest or not. Choosing the right fund, what to look for. Here's what every smart investor should evaluate. Fund objective. What is the fund trying to achieve? Fees and loads. High fees reduce returns over time. Performance history. Check returns over 5 to 10 years, not just last year. Fund manager reputation. A proven track record matters. Volatility and risk profile. Does the fund match your personal risk tolerance? Fund holdings. Where is your money going? Tools and resources for research. AAII Guide. Excellent for beginners, especially for no-load funds. Morningstar reports. Professional grade, data-heavy research. Prospectus. Every fund publishes this summary of goals, fees, holdings, and risks. Broker versus direct purchase, pros and cons. Broker. One-stop access to many funds. Consolidated statements. Personalized advice. At a cost. Direct purchase. Lower costs, no broker commission. May require more paperwork. Must research and manage on your own. Small investors are usually better off buying directly, especially to avoid percentage-based fees on small contributions. Open-end versus closed-end funds. Open-end funds. Create new shares as needed. Bought from the fund company. Price Yosen NAV, net asset value. Closed-end funds. Issue fixed number of shares. Traded on stock exchanges. Price determined by market supply-demand. The psychology and philosophy behind mutual funds. Mutual funds reflect a shift in investment thinking, away from gambling on single stocks, toward strategic ownership of a diversified portfolio, away from speculation and toward measured long-term growth. They're ideal for people who want simplicity, lack time or expertise to pick individual securities, value professional oversight and risk management. Case study, Pax World Fund. Type, balanced, no load. Assets, $500 million. Holdings, blue chip stocks, Quaker Oats, Heinz, etc. Plus top-rated government bonds. Returns, historically variable but solid over the long term. This shows how even a conservative, socially responsible fund can offer respectable long-term growth. Conclusion. Why mutual funds matter. For most new investors, mutual funds provide a safe, diversified entry into the investment world, access to professional management, the ability to tailor risk and investment goals, a path to build wealth gradually and responsibly. In short, mutual funds democratize investing. They give anyone, regardless of time, experience, or capital, a real shot at long-term financial success. Moral of the chapter, mutual funds. 1. You don't have to be a stock-picking expert to invest wisely. Mutual funds offer a simplified, professional approach to investing, perfect for beginners. 2. Diversification is the key to reducing risk. A mutual fund invests in many companies, so losses in a few can be offset by gains in others. 3. Professional fund managers can manage your investments better than you might on your own. You pay a fee, but you get expertise and time saving in return. 4. Mutual funds allow small investors to access large, diversified portfolios. You can start with as little as $500 to $1,000 and grow gradually. 5. No-load funds are often better than load funds. There's little performance difference between funds with fees, loads, and those without, so avoid unnecessary charges. 6. Understand all fees hidden or visible before investing. Watch for front-end loads, back-end loads, 12b-1 fees, and management fees. 7. Buying directly from the fund company is often cheaper than using a broker, especially true for small regular investors. 8. Different types of mutual funds serve different investment goals. Whether you want growth, income, stability, or ethical investing, there's a fund for you. 9. Past performance is helpful, but not a guarantee of future returns. Look at long-term consistency and the fund's strategy, not just last year's results. 10. Reinvesting dividends and distributions can compound your wealth. Even small returns can grow significantly over time if reinvested regularly. 11. Taxes apply to mutual fund income even if reinvested. Be prepared to report dividends and capital gains annually. 12. Open-end mutual funds are priced by NAV, not market demand. This means you're buying shares based on actual asset value, not investor speculation. 13. Fund families offer convenience and variety under one roof. You can diversify your portfolio easily using funds from one management company. 14. Mutual funds are a smart starting point before investing in individual stocks. They help build experience, confidence, and capital while keeping risk manageable. 15. Proper research is essential even with mutual funds. Use guides like AAII, Morningstar, and fund prospectuses to make informed choices. Chapter 7. Fixed Income Investments. A deep dive into safe, steady, interest-bearing investment options. 1. Introduction to fixed income investments. Fixed income investments are financial instruments that provide regular, predictable interest payments over a defined time period. The term fixed income refers to the fixed interest or dividend income these instruments generate. They are not speculative like stocks. Instead, they appeal to investors who prioritize stability, capital preservation, and steady income. Such investments are vital for conservative investors, retirees, or soon-to-be retirees, risk-averse savers, anyone looking to balance their portfolio with dependable income sources. Fixed income products include certificates of deposit, CDs, money market accounts, bonds, bond mutual funds. 2. Certificates of deposit, CDs, a higher-yielding, time-bound version of a savings account. What are CDs? CDs are loan agreements between you and your bank. You agree to leave a fixed sum with the bank for a fixed period, and in return, the bank pays a higher interest rate than a regular savings account. Term lengths, 3 months to 5 years. Common, 6 to 24 months. Minimum deposit, $250 to $1,000. Interest rates, typically 1 to 2% higher than savings accounts. FDIC insurance, up to $100,000 per account per bank. The core concept: banks need to manage how much money they have available for lending. If you agree not to withdraw your money for a fixed time, they reward you with better rates. Advantages: predictable return, zero market risk, FDIC insured up to limits. Risks, limitations: early withdrawal penalty, often 90 days of interest. Locked interest rate may become less attractive if market rates rise. Less liquid than money market accounts. Strategy tip: avoid locking into long-term CDs during low interest rate periods. You'll be stuck with lower returns even as market rates rise. 3. Money market deposit accounts, MMDAs, a flexible alternative to savings accounts with better returns. What is the money market? The money market is where governments, banks, and large corporations borrow for the short term, less than 1 year, by issuing treasury bills, large CDs, over $100,000, commercial paper. Banks pool investor deposits to invest in these instruments, and you earn interest on your share. Features of MMDAs: higher interest than savings accounts. Liquidity: can withdraw anytime, even write a few checks per month. Minimum deposits: $1,000 to $2,000. FDIC insured if the bank is covered. Interest rate volatility: returns fluctuate with market rates. Less stable than CDs, typically about 0.5% below Treasury bill rates. CDs versus MMDAs. Certificates of deposit, CDs, usually offer a slightly higher interest rate compared to money market deposit accounts, MMDAs, but the rate is fixed for the entire term. This means once you invest in a CD, the interest won't change, giving you stability. However, CDs come with low liquidity. You're expected to leave your money untouched for a set period, and withdrawing early often results in a penalty. Because of this, CDs are best suited for long-term savings where you don't need immediate access to the funds. On the other hand, MMDAs typically offer a slightly lower interest rate, but that rate can fluctuate based on market conditions. The key advantage of MMDAs is their high liquidity. You can withdraw your money at any time and even write a few checks each month. This makes MMDAs ideal for short-term savings or emergency funds where quick access to your money is important. In short, CDs are better when you want fixed returns and don't need the money soon, while MMDAs are better when you want flexibility and fast access to your savings. Practical tip: use MMDAs for emergency funds due to liquidity. Use CDs when you can afford to lock away money for higher fixed returns. 4. Credit unions. A community-first alternative to commercial banks. How they work. Credit unions are non-profit cooperatives, owned and operated by their members. They tend to charge lower fees, offer competitive rates, be more welcoming to small depositors, reinvest locally, often lending to fellow members. Advantages: better customer service, small accounts not penalized with fees, insured by federal agencies, verify before depositing, can offer full banking services, CDs, loans, credit cards. Social impact. Community development credit unions also support small businesses, minority groups, and underserved areas. 5. Bonds. Lending your money to corporations or governments. What are bonds? A bond is a loan you give to a corporation or government. In exchange, you receive fixed interest payments, often semi-annually. Return of the principal, face value, at maturity. Key bond features. Issuer, company, city, or country. Face value, amount loaned. Example, $1,000. Coupon rate, fixed annual interest rate. Example, 6%. Maturity date, when issuer repays the principal. Types of bonds. Government bonds, safest. Corporate bonds, moderate risk. Junk bonds, high risk, high return. Pros of bonds. Predictable income, less volatile than stocks. Interest paid before dividends to shareholders. Ideal for capital preservation and income. Risks, default risk. Issuer can't pay. Inflation can erode returns. Lower upside compared to stocks. The Rule of 70, an easy way to estimate how fast your money doubles. Imagine you invest your money somewhere that earns interest like a bond, a mutual fund, or even a savings account. One of the most exciting things about investing is seeing your money grow over time. But have you ever wondered how long it would take for your money to double? That's where the Rule of 70 comes in. It's a simple mental shortcut, not a strict math formula, but it gives you a pretty accurate estimate of how long it will take for your investment to grow to twice its size, depending on the interest rate you're getting. Let's say you're earning 7% interest on your money each year. According to the Rule of 70, your money will double in about 10 years. If you're earning 10% interest, your money will double in just around 7 years. The higher the interest rate, the fewer years it takes to double your money. And the lower the interest rate, the longer it will take. You don't need a calculator or spreadsheet, just a rough idea of your interest rate and this rule in your head. It's a quick tool that helps you visualize the power of compound interest and understand why even a small increase in your return can make a big difference over time. So the next time someone offers you an investment at 6%, 8%, or 10%, you'll have a rough idea of how fast that money might double, and that helps you make smarter financial decisions. 7. How compound interest works. The secret to exponential growth. Basic principle. When interest is reinvested, it earns more interest in the next period. Over time, this interest-on-interest effect causes the principal to grow much faster. Example, year 1, $10,000 multiply. 10%, $1,000, new total, $11,000. Year 2, $11,000 multiply. 10%, $1,100 total, $12,100. Year 3, $12,100 multiply. 10%, $1,210, house total, $13,310. By year 10, the balance $25,900. At 8%, it would only be $21,600. Lesson. Just 1 to 2% difference in interest rate can cause dramatically different outcomes over 10 to 30 years. Compound interest is powerful. Maximize it early and often. 8. Compound interest and mutual funds. Even bond mutual funds, offering 1% to 3% higher returns than money market accounts, can provide substantial long-term gains due to compounding. But mutual funds often charge management fees, example to 1%. 12b1 marketing fees. These small expenses can reduce your effective return. For example, market return 10%, fund fees 2%, your net return 8%. Over time, this results in tens of thousands less in growth due to lost compounding. Solution: choose low-fee, no-load funds with strong long-term performance. 9. Stocks versus bonds. A classic trade-off, risk versus return. Historical returns, 1970-1990. Savings account, after inflation, $11,400. Corporate bonds, $56,000. Stocks, S&P 500, $82,500. Long-term evidence, 1948-1988. Bonds, $10,000, $73,100. Stocks, $10,000, earned $1,000. Inflation and taxes eat returns. 4% inflation plus 2.8% tax, 6.8% loss. Your 10% return becomes only 3.2% real growth. Takeaway: only stocks have reliably outpaced inflation plus taxes over the long term, but bonds provide safety and balance to a portfolio. 10. Bond mutual funds. Rather than buying individual bonds, which require expertise, most investors opt for bond mutual funds. Benefits: professional management, diversification, easy to access, suitable for small investors. Types of bond funds: government bond funds, safest, lower returns. Corporate bond funds, higher income, moderate risk. Junk bond funds, high income, high risk. Avoid if you seek stability. Why use them? Smooth out stock volatility. Create predictable income stream. Lower long-term risk. Conclusion: why fixed income investments matter. Fixed income investments might not be flashy, but they are the backbone of a stable financial life. They offer capital safety, generate passive income, help offset stock volatility, allow financial planning with confidence. A well-diversified portfolio includes both stocks for growth and bonds, CDs, MMDAs for stability. Chapter 8. Finding and interpreting financial information. The two types of financial information. Investors require two primary types of information. Descriptive information tells you what is happening in the market. Analytical information helps you understand what it means and how to respond. For new investors, understanding these layers is essential to avoid confusion and missteps. But just as important is learning the language of finance stock indexes, symbols, abbreviations, and how to interpret tables. The noise filtering financial information. The financial world is overflowing with information news articles, expert opinions, TV shows, investment newsletters, social media posts, and advice from acquaintances. This saturation can paralyze or mislead a new investor, especially when authoritative voices contradict one another. The author compares new investors to a drunk stumbling through a department store chasing every flashy recommendation. This metaphor underscores the dizzying effect of unfiltered financial opinions and highlights the importance of selective attention and skepticism. How to filter and focus. Know your investment goals. This helps you focus on the type of information that's most relevant to your investment strategy. Choose a medium that suits you. Whether it's newspapers like Wall Street Journal, Investor's Business Daily, magazines like Money, Forbes, Fortune, newsletters from trusted advisory services, television, e.g. CNBC, PBS shows like Wall Street Week, or online platforms and databases. Explore these options at a library before committing. Choose based on clarity, relevance, and your ability to understand and act on the information. Financial media, double-edged sword. While media platforms, TV, radio, online, offer real-time updates and expert discussions, they often reflect biased or incomplete views. Remember, for every confident expert predicting a market boom, there's another forecasting doom. Key takeaway: always weigh multiple viewpoints and interpret them through your own understanding and goals. The role of newsletters. Unlike newspapers or broadcasts, newsletters offer focused, long-form, and personalized guidance. For long-term investors, the monthly or bi-monthly frequency of newsletters is just right, providing insight without overwhelming. Reading and interpreting stock tables. Understanding stock tables is like learning a new language. Each number and symbol tells a story. 1. 52-week high-low range of stock price over the past year. Indicates volatility. 2. Dividend. Div. Total dividend per share in the past year. Not guaranteed to repeat. Chuck. 3. Shares traded volume of stocks traded that day in hundreds. Indicates investor interest. Danda. 4. Yield. YLD. Dividend as a percent of the current price. Shows cash return from dividends. 5. P/E ratio, price divided by earnings per share. A measure of valuation. 6. 8. High-low, last daily high, low, and closing prices of the stock. 9. Change net. Change from the previous day's close. Fractions are still used in prices, e.g. 1 to 4 times 0 to 25. So converting them to decimals is essential for accurate analysis. Abbreviations and symbols. Ticker symbols, e.g. GE for General Electric, AAPL for Apple, are identifiers used in trading. Newspapers often abbreviate company names in unique and confusing ways. Symbols like PF, preferred stock, B, bankrupt, or X carry critical meanings. Always refer to the legend in stock tables. The ticker tape and electronic quotes. Modern tickers show real-time quotes using shorthand codes. Example, T4014, year 100 shares of AT&T at 40.25. Quantities are often assumed to be 100 shares unless stated otherwise. Be alert to delays in ticker updates, especially during high trading volumes. Understanding the stock markets. The major U.S. stock markets. Exchange description. NYSE. Big board. Most prestigious. 80% of volume among organized exchanges. Amex, smaller companies, still credible. NASDAQ, high-tech and growth companies, electronically traded. Pink sheets, OTC stocks, represent very small companies not listed on exchanges, often speculative and risky, with limited information. Not recommended for beginners due to potential for manipulation and lack of transparency. As companies grow, they may graduate from pink sheets to NASDAQ, then to Amex or NYSE, each with stricter requirements. Bid and ask prices. Most stocks have a spread, the difference between the price you can sell, bid, and buy, ask. Bid price, is what someone will pay you. Ask price, what you'll pay to buy. For thinly traded stocks, this spread can be significant and acts as a hidden cost. Always factor it into your calculations before making a trade. Stock market indexes, your financial thermometers. Indexes track the performance of selected stocks and indicate the general direction of the market. Index description. Dow Jones Industrial Average, DJIA. 30 major industrial companies. Most quoted but narrow in scope. S&P 500 companies from multiple sectors. Broader and more accurate market measure. NASDAQ Composite tracks over-the-counter tech and growth stocks. More volatile. Amex Market Value Index reflects 800-plus small to medium companies. Wilshire 5000 Value Line, most inclusive indexes, cover nearly all U.S. stocks. International indexes, Nikkei, Japan, DAX, Germany, FTSE, UK, etc. Track these indexes to understand broader market trends. While short-term moves are important, long-term investors should not panic during temporary market downturns. Other crucial information sources. Beyond company-specific data, macro events matter. Politics, e.g. trade policy shifts. International developments, e.g. labor strikes in gold mines. Economic trends, e.g. inflation, interest rates. Your career or interests may give you an advantage. For example, someone in the health food industry may spot trends in dietary products before Wall Street does. This is not insider trading, just intelligent observation. Legal versus illegal knowledge. Legal, industry knowledge from your job or public sources. Illegal insider trading, using confidential non-public corporate info to buy, sell before the news is public. Internet, the new frontier. The web is a treasure trove of financial tools. Real-time quotes, research reports, investment clubs, market simulations. The key is discernment. Not all sources are accurate or reliable. Understanding the market as a living entity. The market often behaves like a sentient being. Why? Investors react to news, e.g., IBM's earnings drop. Other stocks fall in sympathy. Indexes drop. Investors react again, this time to the index drop. This creates self-reinforcing cycles. Learning to interpret these patterns and understanding market psychology is part of becoming a seasoned investor. Chapter 9. Financial Advisors. A deep explanatory guide. The crossroads, deciding to hire help. After immersing yourself in books, discussions, and self-reflection, you may reach the conclusion that your financial journey is too complex or time-consuming to manage alone. At that point, hiring a financial advisor becomes a serious consideration. But before jumping in, you need to answer a fundamental question. Do you want someone to handle your entire financial life or just your investments? This distinction shapes everything that follows: who you hire, how much they charge, how involved you remain, and what kind of results you should expect. The three main types of financial help. Financial planner. Scope. Full-spectrum financial help. Role. Think of a financial planner as a financial architect. They examine every aspect of your life: income, expenses, assets, debts, taxes, insurance, retirement, and long-term goals. Purpose. They don't just give advice, they help you design your future. Emotional benefit. Many people feel a sense of relief and empowerment after organizing their financial life with a planner. It's akin to financial therapy. The chaos becomes clarity. Option. Planners may manage your investments or just help organize your plan. You decide. Investment manager. Scope. Focuses solely on managing your investments. Role. After deeply understanding your risk tolerance, goals, and preferences, they invest on your behalf. Benefit? You delegate execution while still having control over goals and direction. Payment. Typically charge a percentage of assets under management. AUM. Investment advisor. Scope. Provides advice only. You execute trades and manage decisions. Role. Like a coach who helps you train but doesn't run the race. Cost. Usually paid by the hour or per consultation. Not involved in execution. Warning. Be sure they're not simply salespeople in disguise. Advisors who earn commissions on what you buy can have a conflict of interest. Navigating titles and terminology. Advisors go by many names: Certified Financial Planner, CFP, Chartered Financial Consultant, CHFC, Registered Investment Advisor, RIA, Certified Financial Analyst, CFA. Regardless of title, they usually fall into one of the three categories above. Your job is to understand the function, not just the label. How to choose a financial advisor. Step-by-step deep guidance. Choosing a financial advisor is not just a technical task. It's also emotional, personal, and strategic. Here's how to do it intelligently and safely. 1. Start with referrals, but don't stop there. Why referrals matter. Someone you trust has already taken the risk and evaluated the advisor. But don't blindly follow. Your needs, personality, and goals may differ from your friends. Test for compatibility. Do you feel heard and respected? Can you ask stupid questions without shame? Do they speak your language? 2. Use vetted networks. If you don't know where to start, try Social Investment Forum, Funding Exchange. These organizations screen and monitor the advisors they recommend. If clients raise red flags, advisors are removed. 3. Interview multiple advisors. Ask these 5 critical questions. A. Who are their clients? Are they like you in income, financial goals, life stage? Some advisors specialize in wealthy clients or institutions. You may be too small to matter to them. B. What are their credentials? Ask about state registrations and national certifications. Demand to see their ADV form, a public disclosure document required by the SEC. Shows education, experience, fees, legal violations, bankruptcies. Source: SEC, Public Reference Branch, 455th St. N.W., Washington, D.C. 2549. C. How are they paid? Fee-based advisor, paid by the hour, by the project, or as a percentage of assets. Transparent, less chance of hidden agendas. Commission-based advisor, paid when you buy products they recommend, e.g., mutual funds, insurance. May push high-commission products. Not inherently unethical, but you must scrutinize their motives. Rule of thumb: trust, but verify. A commission-based advisor who prioritizes your interests and discloses conflicts is often better than a fee-only advisor who is careless or dismissive. D. What kind of authority will they have over your money? Discretionary account. Advisor has control, makes trades without asking you. Non-discretionary account. You must approve all trades. Discretionary accounts are convenient but risky if you don't fully trust the advisor. Red flags, especially for new investors. Insisting on a discretionary account. Promises of high returns. Evasiveness about background or registration. Not registered with state or national bodies. E. Do they understand and respect your investment philosophy? Are they conservative when you are? Do they try to push you out of your comfort zone? Ask for performance history. How did their past recommendations perform? Compare results to benchmarks or other advisors. 4. Judge their communication clarity. Do they make things clearer or more confusing? Some advisors intentionally use jargon to seem smarter and keep you dependent. A good advisor empowers you, not mystifies you. A trusted advisor should make you feel smarter, not dumber. Small firm vs. large company. Small firms, individuals. Usually fee-based. Often more personal attention. Greater flexibility. Large firms. Often commission-based. More institutional trust. Brand recognition. May prioritize product sales over your needs. Your comfort, not their brand name, is what matters most. Special warning: insurance advisors. These individuals are trained to sell insurance, not to guide your financial life. They may pose as planners but focus primarily on life, health, or annuity products. Red flag: if insurance is the center of the conversation, be wary. A true planner includes insurance as a small part of a complete strategy, not the centerpiece. Final thought: choose with eyes open and mind empowered. Hiring a financial advisor is one of the most important decisions you can make as an investor. It involves entrusting someone with your future, not just your money. Take your time, ask the hard questions, seek transparency, trust your instincts, and stay educated. You are your first and best financial advisor. Chapter 10. Real Estate, Owning a Home, a Deep Dive Guide. They ain't making any more of it. Will Rogers. Real estate occupies a unique corner of the investment world. A single transaction can combine shelter, status, leverage, tax strategy, forced saving, emotional security, lifestyle flexibility, and macroeconomic risk, all in one bundle of wood, steel, concrete, and land. In this chapter, we unpack every layer of that bundle so you can decide analytically and deliberately whether buying a home belongs in your financial plan. 1. Why real estate usually appreciates. Permanent scarcity of land. Supply is capped by geology and zoning, while demand rises with population, income, and household formation. Even when local markets soften, the long-run trend measured over decades has outpaced inflation in most urban areas. Leverage amplifies gains. A 20% down payment gives you 5x economic exposure. If the property price grows 3% a year, your cash-on-cash return before costs and taxes is roughly 15%. The same leverage, of course, magnifies losses, a point many 1990, 91, and 2008 homeowners learned the hard way. Inflation hedge. Mortgage payments are nominally fixed, unless you choose an adjustable rate. Over time, rising wages and prices erode the real burden of those payments, while rents tend to float upward with inflation. 2. Rent versus buy structured self-interview. Before crunching numbers, interrogate preferences and constraints. Stability. How likely am I to relocate within 5 years? Equity builds slowly. Less than 5 years horizon often favors renting. DIY tolerance. Do I enjoy weekend projects and maintenance? Sweat equity can cut costs or drain time and morale. Liquidity needs will tying up 20% plus of my net worth handicap other goals. Down payment and closing costs are illiquid. Risk appetite. Could I handle a 20% price drop plus job loss? Housing is a concentrated, undiversified bet on one market. Emotional value. How much do I value control, customization, roots? Intangibles tilt the scale when the math is borderline. Write honest answers. If most rows align with uncertain or no, renting and investing the difference in diversified assets can be the wiser choice. 3. The economics of a primary residence. Cost components. Upfront, down payment, closing fees, inspection, appraisal, moving, immediate repairs. Recurring fixed, mortgage P&I, property tax, homeowner insurance, HOA fees. Recurring variable, utilities, maintenance, landscaping, replacements, roof, HVAC. One-off shocks, furnace dies, tree hits roof, municipal special assessments. Rule of thumb, budget 1% of property value per year for maintenance, plus a reserved emergency fund equal to 3 to 6 months of housing costs. Tax mechanics, U.S. Interest deduction, up to the first $750,000 of mortgage principal, as of 2025. Property tax SALT cap. Combined state per local tax deduction limited to $10,000. Capital gain exclusion. First $250,000 gain on sale of primary residence held greater than or equal to 2 of last 5 years is tax-free. Run the numbers with your marginal federal and state brackets. These benefits vary widely. 4. Mortgage mathematics in plain English. Amortization anatomy. Every monthly payment. CHPA's interest portion. Principal portion. Early years are interest-heavy. Example. $100,000 loan, 30 years, 10% fixed. Payment. $877. Month 1, $830 interest, $47 principal. Month 24, $819 interest, $58 principal. Because principal shrinks slowly, you pay almost 2x the borrowed amount in interest over 30 years. 20-year versus 30-year loan. 20-year, 30-year, monthly P&I, $965, $877, paid off year 2030. Interest paid, total, approximately equal to $131K to $216K. Break even. If you will own greater than or equal to 5 years and can handle $88 more per month, the 20-year saves Tilda $85,000 in interest and frees cash flow 10 years sooner. Acceleration tricks. Bi-weekly payments, 26 half payments per year. Charge 1 extra full payment knocks Tilda 4 years off a 30 years loan. Round up each month. Adding $100 toward principal from day 1 cuts interest tens of thousands. Refinance only when the all-in interest savings exceed closing costs within your expected holding period. 5. Fix-up strategy, sweat equity. Value spread, years after repair market price minus purchase price, plus rehab cost, plus carrying cost. Margin of safety, require greater than or equal to 15% projected profit to absorb overruns and market dips. Skill versus scale. DIY works on single-family homes. Professional crews, plus finance discipline are essential for multi-unit flips. Lifestyle impact. Living in your job site strains relationships. Have a timeline and contingency fund. 6. Comprehensive pros and cons revisited. Financial positives. Leverage enhanced appreciation. Compounded equity growth. Tax sheltering of interest and capital gains. Inflation-indexed asset with nominally fixed debt. Forced savings principal payments convert consumption, rent, into net worth. Credit building on time mortgage history boosts future borrowing power. Collateral for loans tap equity via HELOC or cash-out refinance. Financial negatives. High transaction friction. 8% round-trip selling costs. Illiquidity in downturns. Concentration. Risk single asset exposure versus diversified portfolio. Carrying cost creep insurance, taxes. Maintenance usually rise faster than CPI. Leverage downside price drops can wipe out equity. Foreclosure risk in income shocks. Opportunity cost capital tied up. Could earn elsewhere with more flexibility. Lifestyle positives. Creative control, stability, potential generational legacy, community integration. Lifestyle negatives. Time sink. Repairs, yard work, reduced mobility, perpetual to-do list. 7. Decision framework in 5 steps. Define horizon. Less than 5 years likely rent. 5 to 10 years evaluate cycle. Greater than 10 years often buy. Stress test budget. Simulate income drop, rate reset, major repair, dual job loss. Price to rent ratio. If annual rent by purchase price greater than or equivalent to 5%, renting may win. Example, $2,000 multiply. 12 was $24,000. Home listed $500 K ratio, Sackers 4.8%. Opportunity audit. Compare expected home equity IRR, after tax, with returns from diversified index funds or business investments. Intangible weighting. Assign a 0 to 10 score to freedom, pride, roots, customization. Multiply by 3% of purchase price. It often tips the scale honestly. 8. Practical checklist before you commit. Build a 6-month emergency fund after down payment. Pull your credit reports. Fix errors, stocks 6 months prior. Get pre-approved, not just pre-qualified. Calculate all-in affordability using the 28 by 36 rule, housing greater than or equivalent to 28%. Total debt less than or equal to 36% of gross income. Inspect ruthlessly roof, foundation, plumbing, wiring, drainage. Price the neighborhood, not just the property. School districts, crime trends, new zoning, employer mix. Lock a realistic rate float-down option if rates fall before closing. Plan exit scenarios, rental feasibility, break-even sale price, alternative markets. Chapter 11. Real Estate as an Investment. A deep explanatory analysis. Introduction. The dream of real estate. Wealth and the reality behind it. The opening of this chapter takes a sharply critical look at the get-rich-quick schemes that have saturated the world of real estate investing. From flashy seminar titles to bold book claims like How I Made $10 Million in Real Estate with No Money Down, the author peels away the glitter to expose the underlying truth. Yes, real estate can be lucrative, but it is neither easy nor effortless. Success requires knowledge, skill, time, and often a high tolerance for risk and people problems. This chapter helps separate myth from method, grounding readers in a realistic, sober understanding of how real estate functions as an investment vehicle, especially through rental properties, raw land, and alternative real estate instruments like REITs and partnerships. Section 1. Rental property. The promise of leverage and the burden of landlordship. Leverage. Small input, large returns, and risks. Leverage is one of the most powerful tools in real estate investing. It allows you to control a large asset with relatively little cash. For example, buy a $100,000 rental home. Put down 20%, $20,000. Borrow the rest. If the property appreciates by 20%, $20,000, your investment has doubled 100% return without you having to double your capital. This concept of using borrowed capital to amplify returns is what makes real estate especially appealing to investors with limited starting funds. However, leverage is a double-edged sword. If property values drop, your losses are magnified just as much as gains. High leverage increases debt obligations, creating cash flow stress if the property doesn't produce enough income to cover costs. The reality of landlordship: it's a job, not a passive investment. Being a landlord is not just about collecting rent checks. It involves tenant management, background checks, evictions, late payments, property upkeep, repairs, remodeling, code compliance, legal responsibilities, landlord-tenant laws, eviction restrictions, fair housing rules. The author's own experience shows that even with good intentions and decent tenants, managing rental property can be emotionally draining and financially volatile. Every tenant is a potential story, some heartwarming, others nerve-wracking. The emotional toll of deciding whether to evict a jobless tenant or cover mortgage payments yourself is a situation many landlords will face. This moral tension is unique to real estate investing and not present in other asset classes like stocks or bonds. Character matters. The Bob example. Bob's success illustrates that personality fit can be the difference between frustration and fulfillment in property management. He enjoyed hands-on work, had construction skills, liked interacting with tenants, took an entrepreneurial approach to expanding his portfolio. This story teaches us that successful rental investing is not just about market timing or location. It's about whether you personally enjoy the work involved. Real estate is part business, part service, part investment. Section 2. Raw land. The speculator's gamble. Raw land sounds simple. Buy dirt, wait, sell high, but it's far from that. Here's why. The upside. High potential returns if development comes. Buy cheap land in a soon-to-expand suburb. Developers come in, demand surges, and values skyrocket. This strategy has created fortunes for those who picked the right spots. The downside: years of costs, no cash flow. Land does not generate income. While you wait, property taxes must be paid. Loan interest accrues if the purchase was financed. Development delays may stall value growth for years or forever. The risk is that development never arrives or arrives elsewhere. This kind of speculation requires local knowledge, market research, patience, financial resilience. In short, raw land is an advanced investment better suited to seasoned speculators than beginners. Section 3. Other forms of real estate investing. This section explores ways to gain exposure to real estate without becoming a landlord or land speculator. These methods are less hands-on but still require diligence. REITs, real estate investment trusts. The mutual funds of property. What they are. REITs are publicly traded companies that pool money to invest in income-generating real estate. Types include equity REITs, own and manage properties. Mortgage REITs, lend money to real estate buyers. Development REITs, fund short-term construction projects. Pros: liquidity, buy-sell on stock exchanges. Diversification, spread across multiple properties. No property management required. Cons: subject to market volatility. Manager skill and location selection matter greatly. Returns vary, some REITs perform poorly. Due diligence checklist. Key questions to ask. Are dividends paid regularly and as projected? Is the cash flow rising? Are the properties high quality and in strong locations? Is there an exit strategy or repurchase program? Is the management team trustworthy? Bottom line, a well-managed REIT can be a strong, diversified, passive investment, a great choice for new or time-constrained investors. Partnerships, shared ownership, shared risk. In a real estate partnership, a general partner runs the operations. Limited partners, like you, provide capital and share in profits, trusts, losses. There are public partnerships, registered with the SEC. Private partnerships, less regulated, riskier. Risks, hard to exit. Vulnerable to fraud and mismanagement. Often require higher minimum investments. Tax benefits exist, but are complex. Always consult a tax advisor. Real estate mutual funds. These are open-end funds, unlike REITs, which are closed-end, that invest in real estate-related companies. REITs, developers and builders. They offer broad exposure, professional management, easy entry, exit. The Fidelity Real Estate Fund is an example of a fund that thrived by identifying niche opportunities, like healthcare properties, even during broader market downturns. This is a lower-risk entry point for new investors curious about real estate without the complexity of ownership. Low-income housing partnerships, profits with a social purpose. Investors can earn tax credits for building or improving low-income housing. Potentially earn 13% to 15% annually from combined income and tax benefits. These credits can be very valuable, but eligibility and compliance rules are strict. You must work with a tax advisor. Commit to long-term affordability, usually 30 years. These investments appeal to socially conscious investors looking to align financial goals with community impact. Second mortgages become the bank. You can also invest by lending money to home buyers through second mortgages. Offers higher returns, 10% to 15%. Often comes with guarantees from finance companies. Risks. Defaults in a recession. Requires deep due diligence on borrower and property. This is not for beginners, but offers an interesting niche for those with capital and a solid grasp of credit evaluation. Final thoughts. What to do if real estate still interests you? If this chapter hasn't scared you off, then you might be ready to begin. But begin carefully and with humility. Key first steps. Subscribe to expert newsletters, e.g. John T. Reads. Read books by people who don't sugarcoat the process. Speak to experienced investors. Know your goals, budget, and preferred locations before talking to agents. Consult a tax professional. If you inherit property, get it professionally appraised before trying to sell or rent it. Real estate can be an asset or a liability depending on how it's handled. Part 2. Intermediate Investing. This section dives deeper into the mechanics of investing. It covers topics like asset allocation, diversification, risk management, stock analysis, and tax considerations. Purpose: to empower readers with practical skills and strategies to make smarter investment choices. It aims to transition readers from novices to competent, self-directed investors who can build a well-balanced portfolio. Chapter 12. Socially Responsible Investing. A Deep Explanation. 1. The Origins of Socially Responsible Investing, SRI. The story of socially responsible investing, SRI, begins with a personal contradiction. Someone who gives money to environmental organizations realizes he also holds stock in a company that harms marine life. This moment of realization encapsulates the entire concept of SRI, aligning your investments with your ethics. While ethical investing has historical roots, dating back to religious groups avoiding sin industries like gambling and alcohol, it was in the 1970s, amid rising concern for civil rights, environmental degradation, and corporate ethics that SRI began to emerge as a widespread movement. Over time, SRI has matured into a serious, data-driven investment discipline supported by institutional players, mutual funds, and global rating agencies. 2. What is socially responsible investing? Socially responsible investing, SRI, also known as ethical investing, social investing, sustainable investing, green investing. It's an investment strategy that aims to maximize both financial return and social good. Rather than purely chasing profits, the social investor screens investments using non-financial criteria, such as environmental impact, worker treatment, product safety, human rights record, political affiliations. For example, a socially responsible investor may avoid companies that pollute heavily or destroy biodiversity, sell tobacco, alcohol, or weapons, discriminate against employees or violate labor laws, do business with authoritarian regimes. 3. Why SRI matters. Beyond profits to purpose. Traditional investing is based on the assumption that capital naturally flows to where it generates the best financial return. But SRI adds another dimension. Capital is also a tool of power and responsibility. Money is not morally neutral. Where you invest it influences the world. By choosing to invest in companies that promote clean energy, human rights, or ethical labor, investors vote with their dollars, pushing businesses toward accountability. Likewise, by avoiding companies with damaging practices, investors create financial pressure for reform. In short, every investment supports or discourages certain values. SRI turns investing into an act of social and environmental citizenship. 4. Good ethics can be good business. One of the persistent myths around SRI is that it sacrifices performance, that doing good means earning less. This assumption has been proven wrong repeatedly. From May 1990 to April 1996, the Domini 400 Social Index, a benchmark of socially screened companies, returned 156%, outperforming the S&P 500's 139.4% during the same period. Why do ethical companies often outperform? They avoid long-term liabilities, e.g., lawsuits from pollution or discrimination. They tend to have stronger employee morale and retention. They are more attuned to market shifts, e.g., rising demand for sustainable products. They build stronger brand loyalty among conscious consumers. Case in point, after the Exxon Valdez oil spill, Exxon faced massive cleanup costs, reputational damage, and regulatory scrutiny. Meanwhile, green competitors gained both consumer trust and market share. 5. The rise of socially responsible mutual funds. Mutual funds specializing in SRI use social screens to determine which companies to include or exclude. These screens can be either negative screens, avoiding tobacco, weapons, polluters; positive screens, actively seeking out clean tech, fair labor, or community development firms. Different funds apply different criteria. For example, some may allow military contractors but avoid alcohol companies. Others may tolerate nuclear energy but shun fossil fuels. Thus, investors must read the prospectus of each SRI fund carefully to ensure their personal values align with the fund's philosophy. Warning: some funds use greenwashing, marketing themselves as sustainable while investing in polluters. Tools like the Green Money Journal help investors verify a fund's true commitments. 6. Navigating complex ethical trade-offs. SRI is rarely black and white. Most companies are mixed bags, good in some areas, questionable in others. Examples of ethical complexity. A solar energy company may also operate nuclear plants. A biotech firm curing diseases may conduct animal testing. A corporation with excellent diversity practices might sell sugary drinks, contributing to public health crises. This raises crucial questions for investors. Where do you draw your ethical line? Is partial compliance enough, or do you demand total alignment? Would you accept short-term underperformance for a cleaner conscience? Every SRI investor must do their own soul searching. The field is not about finding perfect companies, but about making informed, intentional choices. 7. Shareholder activism. Changing companies from within. Avoidance isn't the only route. Instead of selling stocks of unethical companies, you can buy them and push for change from within. This is known as shareholder activism. When you own common stock, you become a part owner of the company. You get to vote on company policies. You can propose shareholder resolutions if you meet basic criteria, e.g., owning $1,000 of stock for at least 12 months. Shareholder activism enables small investors to band together and pressure companies to improve environmental policies, demand better labor standards, influence political contributions, or supply chain transparency. Capital, when combined with conscience, becomes a tool for systemic reform. 8. SRI and government or banking investments. Social investors must think beyond stocks and mutual funds. Even where you park your savings or lend your money matters. Examples: buying U.S. Treasury bonds supports federal government policies, including deficit spending, military budgets. Saving at a large commercial bank may indirectly support lending to corporations you find objectionable. Choosing a community development bank or credit union supports local, ethical lending and social impact. Every dollar placed is a seed planted. The question is, what kind of world do you want it to grow into? 9. 2 philosophies of SRI. SRI typically follows one or both of 2 paths. A. Do no harm. Negative screening. Avoid investments in companies that violate human rights, harm the planet, engage in unethical business practices. B. Do good. Proactive or impact investing. Seek out companies and funds that develop renewable energy, promote equitable labor policies, solve pressing social or environmental problems. Some funds and investors use both strategies, excluding the bad while rewarding the good. 10. Resources for socially responsible investors. There's a growing ecosystem to support SRI, journals and newsletters. Green Money Journal. Regular updates on SRI funds, articles, and events. New Energy Report. Focus on companies solving environmental challenges. Books. Investing from the Heart by Jack A. Brill and Alan Reeder. Explains the SRI landscape. The Socially Responsible Guide to Smart Investing by Samuel Case covers proactive environmental investing in depth. Organizations: Social Investment Forum, a national network connecting investors, advisors, and mutual funds with a social conscience. 11. Conclusion. The moral dimension of money. Socially responsible investing is more than a financial strategy. It's a personal, ethical, and even spiritual journey. It challenges investors to ask, what does my money support? What kind of world am I building with my investments? Can I achieve profit and purpose? By embracing SRI, investors don't just manage wealth, they shape the future. And as history has shown, ethics and profits can walk hand in hand. Chapter 13. International Investing. The Rise of Global Investing. From elite access to everyday strategy. For much of the 20th century, investing in foreign markets was a luxury limited to the ultra-wealthy. It required specialized knowledge, international banking access, and often large capital reserves. However, the last few decades have witnessed a revolutionary shift, often referred to by economists as globalization, the increasing interconnectivity of economies, financial markets, and capital flows. This shift has made international investing far more accessible, even for the average investor. Globalization has not just opened new doors, it has also exposed American investors to the reality that foreign economies can outperform the U.S. market, sometimes dramatically. For example, from 1985 to 1990, a notable bull market period in the U.S., the American stock market ranked 16th out of 18 among major world markets. Countries like Japan and other Asian economies experienced explosive growth. The core principle here is diversification. Just as you wouldn't put all your money into one stock, you shouldn't confine your entire portfolio to one country. A well-balanced portfolio should allocate 15% to 20% to foreign investments, helping to reduce risk and potentially increase returns during times when the U.S. economy lags. Vehicles for global exposure. Getting started without leaving home. You don't need to open an account in London, Zurich, or Tokyo to invest abroad. Several accessible tools make international investing as easy as buying a domestic stock. 1. International mutual funds. These are mutual funds that pool investors' money to buy stocks and bonds from other countries. There are two main types. International funds. These invest only in foreign securities. Global funds. These invest in both foreign and U.S. securities, though they may have only 25% exposure to foreign assets. These funds provide an easy, professionally managed path into foreign markets. You can choose between regional funds like Europe or Asia, country-specific funds like Japan only or Brazil only, sector-based international funds, technology companies across countries, for example. However, past performance is not a reliable indicator of future returns. A fund that dominated during Japan's 1980s boom suffered a major crash in 1990-91. So, when picking international funds, focus on future prospects, not just historical gains. 2. Closed-end country funds, volatile but strategic. These are mutual funds with a fixed number of shares, traded like stocks on an exchange. Unlike open-end funds, they can trade at a premium or discount to their net asset value, NAV. NAV, the total value of the fund's assets divided by the number of shares. Premium, when fund shares trade above NAV. Discount, when shares trade below NAV. Example, if a fund has an NAV of $10 and is trading at $8, it's at a 20% discount. If it's trading at $15, it's at a 50% premium. These discounts can present buying opportunities, especially in funds tracking strong economies that are temporarily out of investor favor. However, they can also signal a lack of market confidence, so due diligence is essential. Volatility in these funds often comes not from the underlying economy, but from investor psychology. A large investor's decision to sell can trigger panic selling, even if the country's fundamentals remain strong. The Korea fund swings from $37 to $11 in 1 year are a prime example. Strategy: buy low, wait for sentiment. Buying country funds at a discount to NAV is not unlike buying undervalued stocks. But there's a twist. Prices will only rise when investor sentiment shifts. This makes international investing a game of both fundamentals and perception. To strategize, look for strong economies that are currently unpopular. Watch if the fund's price is stabilizing or beginning to rise. Only enter if you're willing to wait for the market to change its mood. This is not for short-term speculation, but for those with the patience to wait for perception to align with reality. ADRs, American Depository Receipts, direct foreign stock exposure. If you want to invest directly in foreign companies, but without the hassles of international banking, consider ADRs. ADRs are U.S.-traded certificates representing shares in foreign companies. They allow Americans to avoid issues like currency conversion, foreign taxes, and overseas brokerages. ADRs simplify international stock ownership while maintaining exposure to foreign markets. However, the underlying risk remains. You're still investing in the country's political, economic, and currency stability. For example, buying an ADR for a Philippine mining company exposes you not just to mining risks, but to Philippine political volatility. A coup or policy shift could devastate the stock and the value of the local currency. The currency factor, the hidden risk, opportunity. When you invest in foreign assets, you're also investing in the currency of that country. If the local currency falls in value relative to the US dollar, your investment loses value, even if the underlying stock price stays the same. Conversely, if the local currency rises, you gain additional profits through currency appreciation. Illustration. Suppose you buy German stocks when 1 USD changes 2 Deutsche Marks. Later, the exchange rate shifts to 1 USD worth 1.6 Deutsche Marks. When you sell, your marks are worth more in dollars, adding to your returns. Some advanced investors trade currencies directly, but that requires specialized knowledge and is not recommended for beginners. Mutual funds, especially large international ones, often hedge currency risks or manage them on your behalf. That's why they're an excellent starting point. International Socially Responsible Investing, SRI. Ethical investing doesn't stop at national borders. A growing number of international SRI funds focus on environmental sustainability, human rights, fair labor practices. Europe is especially strong in this arena. Funds like those in the Calvert Group offer international SRI options. For individual stocks, consult with socially responsible advisors who specialize in global investments. Advanced international investing, going global with confidence. Eventually, experienced investors may choose to go beyond mutual funds and ADRs to buy foreign real estate, open foreign bank accounts to benefit from higher interest rates or stronger currencies, invest in local markets through international brokerages. Doing so requires understanding local tax laws, capital controls, restrictions on moving money in, out, investment regulations, and often foreign languages. This is where a full-service international broker from a firm like Merrill Lynch or Morgan Stanley becomes invaluable. Conclusion: a world of opportunity and risk. International investing is both financially wise and intellectually stimulating. It reminds you that your financial well-being is increasingly tied to the fate of the global economy. You start noticing news from Asia affects your portfolio. The BBC becomes more relevant. Foreign elections or monetary policies start to matter to your wealth. Yes, international investing introduces new complexities, currency risk, foreign policy, market sentiment, but it also adds powerful diversification, enhances long-term growth potential, and brings a broader awareness of how interconnected the world truly is. Chapter 14. The Model Portfolio. The purpose of the model portfolio. Up to this point in the book, you've been introduced to the many different areas of investing: stocks, mutual funds, bonds, real estate, international markets, and more. Now, it's time to shift from acquiring general knowledge to application. However, this application is not about immediate action, it's about strategic planning. A model portfolio is introduced as a template or prototype that new investors can study, adapt, and use as a benchmark to build their own investment plan. It is structured with a particular goal in mind: long-term capital growth with moderate risk, suitable for someone new to the investing world. This portfolio is not rigid. It is flexible and adjustable, especially as your goals evolve or as market conditions change. It reflects diversification across asset classes, a balance between risk and safety, an emphasis on growth over income, a method to begin investing without needing to pick individual stocks. Why use mutual funds? The foundation of this model portfolio is built around mutual funds, especially for beginners. Why? Diversification. One fund may hold hundreds of stocks or bonds, instantly spreading risk. Professional management. Skilled fund managers research, select, and monitor securities. Ease of performance evaluation. Mutual fund returns are published and can be compared against market benchmarks. For new investors, mutual funds offer a combination of safety, performance tracking, and convenience. The components of the model portfolio. Let's break down the core categories that make up this portfolio, each selected for specific roles in the portfolio's performance and resilience. 1. Equity income and balanced funds, 20%. Purpose: provide stability, steady income, and moderate growth. Equity income funds invest in high dividend-yielding stocks, usually stable, mature companies like utilities. Balanced funds invest in a mix of stocks and bonds, aiming to preserve capital while also producing income and growth. Key insight: dividend reinvestment significantly boosts long-term returns. Utilities often serve as a stabilizer. They maintain dividends even during downturns, softening volatility. Allocation: 10% to the best equity income fund, 10% to the best balanced fund. 2. Growth funds, 20%. Purpose: deliver capital appreciation through investments in companies with high growth potential. Includes both growth and aggressive growth mutual funds. These funds often focus on dynamic sectors like tech, consumer innovation, or biotech. Key insight: past performance should be considered, but it's not the only factor. Look at consistency, management quality, and economic outlook. Allocation: 10% each into 2 top-performing growth funds. 3. International funds, 15%. Purpose: geographic diversification and exposure to global economic trends. 5% in a European fund, 10% in a worldwide global growth fund. Why go global? Over the long term, foreign markets have often outperformed the U.S. market. International funds can buffer domestic downturns and offer growth from emerging and stable economies alike. Risks to monitor: political instability, especially in Eastern Europe and developing nations. Currency fluctuations, regional recessions. 4. Small cap funds, 15%. Purpose: capture the higher return potential of small companies. Small cap stocks have historically outperformed large cap ones over long periods. However, they come with greater volatility, especially during economic uncertainty. Investment strategy: rather than picking individual small cap stocks, invest in a diversified small-cap mutual fund to mitigate the higher risk. Allocation: 15% in 2 well-diversified small-cap mutual funds. 5. Bonds, 20%. Purpose: provide stability, income, and act as a buffer during stock market volatility. 10% in a domestic bond fund, U.S. government and AAA-rated corporate bonds. 10% in an international bond fund. Key features: bonds don't typically grow in value like stocks, but provide predictable interest payments. Compounding through reinvestment of this income adds value over time. International bond funds offer currency and economic diversification. 6. Cash, 10%. Purpose: ensure liquidity, opportunity readiness, and safety. Cash is kept in a money market fund, providing modest interest, 3 to 9% depending on market rates. Also, mutual fund managers themselves typically hold 5 to 20% of their fund assets in cash. Strategic use: having cash on hand allows an investor to seize buying opportunities during market dips. For individual stock investors, holding 15 to 20% in cash is a conservative strategy. Final portfolio allocation: asset class and percentage. Equity income. Balanced funds, 20%. Growth funds, 20%. International funds, 15%. Small cap funds, 15%. Bonds, domestic and Intel, 20%. Cash money market, 10%. Total, 100%. Diversification summary: 10 mutual funds plus 1 money market fund is equal to manageable and balanced. Buy and hold strategy is advised. This isn't a trading portfolio. Beating the averages. A cautionary note: many investors are obsessed with beating the averages, outperforming the S&P 500 or other benchmarks. However, in reality, most professional fund managers fail to beat the S&P 500 consistently. The model portfolio focuses instead on safety, balance, and long-term growth, a smarter aim for beginners. Bottom line: trying to beat the market in the short term is like trying to predict the weather a year in advance. It's better to focus on balance and consistency. Philosophy behind the model portfolio. The model portfolio isn't just a list. It's a blueprint guided by principles. Long-term growth over income. Dividends and interest are reinvested to harness compounding power. Moderate risk profile. Except for small caps, most holdings are conservative. Middle of the risk-reward spectrum. Not too aggressive, not too cautious, a healthy balance for most beginners. Time horizon matters. Volatility becomes less significant over long periods. Modifying the portfolio. As an investor grows in skill or wants to align investing with personal values or life changes, the portfolio can be modified. For more safety or income, increase bond or equity income allocation. For more aggressive growth, increase small cap and growth fund exposure. For social responsibility, use ESG, environmental, social, governance, or socially responsible funds in each category. Because mutual funds are flexible, you can invest small or large amounts and adjust allocations easily. The rule of 10%. What kind of return should a new investor expect? A realistic and respectable target is 10% average annual return. This figure factors in the good years and the bad. It avoids the trap of chasing get-rich-quick schemes. Over time, even with some losing years, a 10% average is a powerful compounding engine. Aim for consistent returns, not spectacular ones. The model portfolio is structured to offer just that. Final thoughts on Chapter 14. The model portfolio is not meant to be the only way to invest, but it's a rational, time-tested, and beginner-friendly starting point. It teaches key lessons. Diversify wisely. Respect risk. Reinvest earnings. Think long-term. Be flexible and informed. The journey of investing begins not with frantic buying and selling, but with thoughtful planning. This chapter provides the map. The next will teach you how to chart your own course using this map as a guide. Chapter 15. Building a successful portfolio. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Benjamin Graham, father of value investing. This profound quote sets the tone for Chapter 15. Investing is not speculation. Building a successful portfolio is not an act of chance or emotional instinct. It is a calculated, disciplined process that rests on 4 foundational pillars: design, quality, diversification, performance evaluation. Let's examine each of these concepts in depth and understand how they come together to create a strong, resilient, and rewarding portfolio. 1. Portfolio design. Purpose before product. Design is strategic thinking. Before selecting even a single investment, you must be crystal clear about your financial objectives, risk tolerance, investment time horizon, and income needs. This initial planning will act as a compass for all future decisions. The importance of purpose. Are you building wealth for long-term growth, e.g., retirement? Do you need regular income, e.g., post-retirement, or supplementing a salary? Are you aiming for capital preservation more than high returns? Each goal requires a different asset mix. Example: a growth-oriented investor may lean toward small company stock funds, international equity funds, less cash, fewer bonds. An income-focused investor may favor bond funds, utility stock funds, blue-chip dividend-paying companies. The model portfolio introduced in Chapter 14 was designed with a moderate growth, safety-first strategy, ideal for many beginning or conservative investors. 2. Buying high-quality investments and holding on. This chapter emphasizes one time-tested, reliable method of investing: the buy-and-hold strategy. This method is simple but not simplistic. Buy only after careful analysis. Hold for the long term unless performance or market dynamics demand a change. Key characteristics: reduces emotional reactive behavior, panic selling in downturns. Benefits from compounding over time. Avoids excessive transaction costs and taxes. Wisdom from the masters. Famed investors like Warren Buffett, Peter Lynch, and John Templeton have used this approach to generate immense wealth. The secret was not daily market timing, but patient, principled investing in quality assets. When to sell? Even in a buy-and-hold model, selling is justified when a mutual fund or stock underperforms its peers for 1 to 2 years. Future prospects weaken significantly. A market shift or macroeconomic event changes the risk landscape. 3. Choosing the best funds. How to do it well. Use reliable resources. Refer to books and journals like Morningstar, Value Line, etc. to compare performance of funds over the last 5 years. Understand the investment style, geographic exposure, and holdings. Example, choosing an international fund. Let's say you're looking at 3 international mutual funds. 2 top performers are heavily weighted in Japan, but the Japanese economy is currently struggling. The third fund is well diversified globally, offering better risk control. Conclusion: choose the third fund. Historical returns must always be filtered through present economic context and future expectations. Call for the prospectus. Before investing, call the fund's customer service and request a prospectus. It details fund philosophy, asset allocation, management style, fees and charges. If the investment philosophy matches your purpose, go ahead and invest. 4. Diversification. The golden rule of stability. Purpose of diversification: to reduce risk without sacrificing return. You're not betting on one horse, you're building a team. Balanced exposure. Different assets behave differently during market cycles. For example, stocks may drop during a recession. Bonds may hold steady or even rise. Utility and dividend funds may continue paying income. International funds may be insulated from domestic downturns. This blend buffers your portfolio and provides smoother returns. Mix of fund types. An ideal portfolio may include blue chip stock fund, small cap stock fund, bond fund, government or corporate, utility fund, international equity fund. Each brings a unique risk-return profile. Avoid false diversification. Having 3 high-risk funds, e.g., a biotech fund, junk bond fund, and gold mining fund, is not true diversification. These may all crash together during economic shocks. Even small investors must diversify. Even if you only have $2,500, split it across 5 different funds, e.g., $500 each. Expand over time. Ideal number for beginners, 5 to 10 funds. 5. Performance. Monitor, measure, manage. Once your portfolio is built, ongoing evaluation is critical. Performance analysis ensures your portfolio continues to meet your goals. Evaluation timeline, weekly check-ins. Glance at fund prices and market conditions. 6-month reviews. Deep analysis of performance, realignment decisions. Tools. Use the Portfolio Simplifier, a recommended record-keeping tool. Or use finance software like Quicken or apps from investment platforms. What to look for? Compare your fund's performance against its category average. Ask, has my fund underperformed peers by a large margin? If yes, why? Example, your aggressive growth fund gained 8% over 2 years, but the category average was 15%. Consider replacing it with a better performing fund. Watch for macroeconomic changes. Even strong performers may face sudden headwinds. Suppose a European small-cap fund has delivered 18% annually for 3 years, but geopolitical tensions or a spike in oil prices may threaten future growth. Consider selling part, example 70 to 80%, to lock in gains while retaining a small position in case conditions improve. Maintaining balance, don't let winners distort your plan. Sometimes one fund outperforms so much that it becomes a disproportionately large part of your portfolio. Rebalancing. If your small-cap fund grows from 15% to 25% of your portfolio, sell a portion to reduce it to 20% or original allocation. Reinvest the profit into lagging but still sound categories. This maintains discipline, prevents overexposure, and reduces risk. Final thoughts. A portfolio is a living strategy. A successful portfolio is not static. It evolves with Your life goals, market cycles, global developments. The keys are clarity of purpose, careful selection, diversification, and ongoing review. Investing is not about making quick money. It's about sustained wealth creation, downside protection, and adapting with wisdom. Chapter 16. Individual Portfolios. 1. Why one-size-fits-all never fits in investing. The model portfolio you met in Chapter 14 is a template, not a prescription. Think of it as a skeletal map of asset classes and risk buckets. Your flesh, goals, cash flow needs, temperament, tax bracket, career stage, even geographic location, must be layered on top to produce a portfolio that actually works for you. Before committing a single dollar, 3 self-diagnostic questions act as your compass. Compass question. Question number 1. How involved do you want to be? Outsource entirely. Minimalist set and forget. Daily hands-on. Question number 2. Which life goals must the portfolio finance? Question number 3. How much volatility can you truly stomach? Why it matters? Determines who makes allocation and rebalancing calls. Fixes time horizon and splits the return target into growth versus current income. Lines up the sleep test with the statistics of drawdowns. Portfolio lever it moves. Choice between discretionary advisor, low-cost index funds, or self-directed brokerage. Duration of fixed income sleeve, equity tilt, use of tax-advantaged wrappers. Equity bond mix, use of real estate, gold, alternatives. 2. X-ray of 6 contrasting case studies. Each vignette that follows is a mini laboratory. Together, they illustrate how the same building blocks, cash equivalents, bonds, equities, real estate, and wildcards recombine to meet radically different needs. Jim the Sculptor. Income today, cushion tomorrow. Profile parameters. Age 35, single. Fresh capital $25,000 lump sum. Constraints. No pension. Erratic cash flow. Emergency fund already in place. Goals replace 2 to 3 days of odd job wages each month. Allow capital to compound for old age. Allocation logic. $20,000. 2 bond mutual funds. International plus domestic corporates. Blended 10% yield. Rationale. Predictable coupon stream. SPA, $165 per month. Freeing up creative time. A non-monetary yet high ROI use of capital. $5,000. 5 diversified equity funds. Global conservative growth. Utilities. Environmental large cap. Small cap growth. S&P 500 index. Rationale. Long runway plus reinvested dividends is equal to compounded tailwind. Even modest 12.5% CAGR projects to $171,000 in 30 years. Key insight. For a creator, time is the scarcest asset. Buying it with bond income is effectively an investment in human capital, often superior to squeezing a few extra basis points from riskier assets. Susanna the Ambitious Buyer, supercharge for early retirement. Age 28. Capital $25,000. Risk appetite above average. Engagement level low. Prefers quarterly check-ins. Dream retire in 15-20 years with this $500,000 corpus. Why her allocation skews growth. Employee Stock Purchase Plan, ESPP, $8,000 purchases, $10,000 worth of company shares, thanks to employer's 25% match. Insider knowledge plus alignment with firms' fortunes deliver both financial and psychological value. International and thematic equity funds dominate the rest. Global growth, European aggressive growth, twin environmental funds, large and small cap, plus a utilities equity fund for a dash of stability. Tiny bond sleeve, WOWS 500, provides ballast but doesn't dilute upside. Projection spectrum, CAGR, 8.5%, Govt bonds, 10 years, $54,000, 20 years, $128,000. 30 years, $289,000. Dwell percent base case, 10 years, $78,000. 20 years, $241,000. 30 years, $750,000. 15% bull case, 10 years, $100,000 is 1,000. 20 years, $410,000. 30 years, 165M. Key insight. Compounding is a lever that multiplies early decisions. Each percentage point shaved off return expectations lops years off the retirement timeline. Hence, Susanna's tolerance for higher volatility now. Dr. Janet. Barbell, safety, plus intellectual speculation. Age 52. Capital $100,000. Distinctive edge medical domain expertise. Personality analytical, enjoys the game of markets. Two-bucket strategy. Core, $50,000. Model portfolio, with a $5,000 real estate fund tweak. Objective, hands-off, tax-efficient compounding for retirement. Satellite, $50,000. High-engagement assets. $35,000 in 20 small-cap medtech stocks filtered through newsletters plus professional insight. $5,000 in carefully researched rare coins, a tangible diversifier with low correlation. $10,000 in pure trading speculation options, junk bonds, gold futures, sized so a blow-up won't jeopardize long-term security. Key insight. A barbell allows intellectually curious investors to scratch the trading itch without endangering the nest egg. Position sizing, not market timing, is the true risk governor. Pete and Marilyn, middle-income parents, leverage tax shelters and real estate. Ages early 30s, income $32,000 after tax, surplus $250 per month. Goals college for 2 kids, plus retirement. Implementation path, cash flow funnel, $165 per month into a tax-deductible IRA, bond and balanced funds. $85 per month extra mortgage principal, knocks 5 years off loan term, saving $31,500 interest. Future optionality. Mortgage-free by year 15 aligns with first tuition, bill housing equity becomes a bank of mom and dad. Post-college cash flow can seed a rental property or mutual fund portfolio. Key insight. Debt reduction is an investment. The guaranteed tax-free return equals the mortgage rate, often beating safe bond yields with zero market risk. Mike and Sarah. 7-figure windfall, lifestyle pivot, advisor partnership. Age early 40s, lump sum $1,000 inheritance. Aspirations, Mike write novel, Sarah launch boutique. Self-awareness. Need emotional decompression, 6-month cooling off CDs. Outcome after reflection and professional guidance. $800,000 with a fee-only planner. Globally diversified equity funds. Socially responsible tilt. Plus bond funds approximately equal to 6% income, $48,000. $100,000 into father's apartment complex. 10% cash yield. $100,000 venture capital to Sarah's shop. Willing to risk 100%. Key insight. A cooling off period plus. Fiduciary advice shields windfall recipients from rash decisions while segregating mission-critical income capital from entrepreneurial risk capital. Low-income investor, $1-a-day snowball. Starting surplus $50 to $100 per month. First milestone emergency fund. Yarger 3x monthly expenses. Investment ladder. Sequential purchase of $500 minimum no-load funds. Bonds, utilities, balanced, blue chip, international, small cap. Math of modest means. At $1 a day, invested ordered 11% and fully reinvested, the pile can exceed $205,000 in 30 years, proving time plus discipline outmuscle income level. 3 special topic real estate in a paper asset portfolio. Direct ownership, home, rental, flip. Risk approximately equal to 5 to 8 on a 10-point scale, depending on leverage and property quality. REITs, real estate mutual funds, liquid, diversified proxies, occupy the mid-risk zone, ideal for investors priced out of physical property. Tip: treat your primary residence as an illiquid bond with an embedded call option on local housing prices. It diversifies stock volatility but ties up capital and geographic flexibility. For Cash V's Capital Firewall. Keep greater than or equal to 3 months' expenses in immediately accessible money market CDs. This quarantines need-it-now cash from market swings and prevents forced liquidation at fire sale prices. Chapter 17. Retirement. A new beginning, not the end. Redefining retirement in the modern age. Traditionally, society has drawn a firm line between two stages of life: the working years and retirement. In this outdated view, one worked tirelessly until age 65 and then abruptly stopped, entering a passive phase marked by leisure and decline. However, this paradigm is no longer adequate for modern aspirations or realities. A cultural shift is occurring. Many younger people are no longer content to delay personal freedom and fulfillment until they are senior citizens. They want to pursue interests, creativity, and exploration while still relatively young. Conversely, many older individuals wish to remain engaged and productive even after retirement. The artificial division of life into work and rest is being dismantled. Instead, the goal is a life of balance, flexibility, and purpose, one where work, leisure, learning, and contribution are all part of the journey at any age. Key idea: retirement isn't about stopping. It's about having the freedom, financial and personal, to choose how to spend your time. Income and investments. Building your financial freedom. In Chapter 16, we explored how to construct a personalized portfolio. Retirement planning is a direct continuation of that work. Except here, the portfolio becomes your paycheck. The power of time and compounding. If you begin saving and investing early, you harness the two most powerful forces in personal finance. Time. The earlier you start, the more your investments can grow. Compounding. Earnings generate more earnings over time. Whether you contribute a lump sum or invest a modest amount monthly, disciplined long-term investing creates a substantial retirement fund. Tax-deferred accounts, your secret weapon. Tax-deferred plans such as IRAs, 401k, and KEO plans supercharge retirement savings. These accounts allow tax deductions now, lowering your annual taxable income. Tax-free growth on interest, dividends, and capital gains. Taxes only upon withdrawal, often when you are in a lower tax bracket. The difference between investing in a regular taxable account versus a tax-deferred plan over 20-plus years can mean hundreds of thousands of dollars in additional savings due to compounding without the tax drag. Glenn and Alice, a case study in smart retirement. To bring retirement planning to life, let's examine a real-world example. Glenn and Alice retire at 65 with the following assets. Social Security. Glenn worked. Alice was a homemaker. A pension. $100,000 in savings. A paid-off home. Health and long-term care insurance. This couple represents a well-prepared retirement. Let's analyze their plan. Emergency and end-of-life preparation. $5,000 is held in a money market account for emergencies. $5,000 is put in a CD, certificate of deposit, reserved for funeral or unexpected end-of-life expenses. This setup ensures liquidity and peace of mind. The core portfolio, $90,000. $70,000 goes into a blend of bond mutual funds and high-yield stock funds, with an emphasis on utilities for stability and income. Expected annual return, 8%, $5,600 a year. Usage, $4,000 for discretionary spending, like travel. $1,600 reinvested for future growth. $20,000 is actively managed by Glenn. Focus, Blue-chip dividend-paying stocks. Goal: fund grandkids' future college tuition. Glenn becomes an active learner and investor, demonstrating that retirement can be a time of discovery and growth. Their strategy balances safety, income, growth, and legacy planning. Tax-deferred plans. Detailed explanation. Types of plans. IRAs, individual retirement accounts. 401k plans, employer-sponsored. KEO plans, for the self-employed. SEPs, simplified employee pensions. Common features. Annual contribution limits apply. You reduce taxable income by contributing. You defer taxes on investment gains until withdrawal. The power of tax deferral: double your money. Example: if you invest $500 a month in a KEO plan, tax savings, $1,680 annually if in the 28% tax bracket. Investment grows at 10% annually, $379,684 in 20 years. Compare this to a taxed account. Post-tax contribution, $360 a month. Final amount after 20 years, $192,150. Conclusion: tax deferral nearly doubles your wealth over time. Don't just save. Save smart with tax efficiency. Rules and penalties. You must start withdrawing from IRAs by age 72, or 73 now depending on new laws. Early withdrawal, before age 59, 1-2, often incurs penalties unless under exceptions, e.g., disability, first home, etc. Contributions must come from earned income, not investment income or Social Security. Insurance: don't overlook protection. Extended care insurance. This pays for long-term disabilities such as stroke recovery or dementia care. Most health plans don't cover long-term rehabilitation or nursing home costs. Extended care coverage prevents your assets from being wiped out. It's cheaper if purchased early, age 40 plus, but still valuable later. Carefully compare policies and check the financial health of the insurance company before purchasing. Planning and caution: the final words. Whether you're 25 or 75, you can take concrete steps toward financial independence. But two final themes are essential. 1. Customize your plan. Think deeply about what you want your retirement to look like. Then, align your savings, investments, and insurance accordingly. Retirement is not a single number or age, it's a lifestyle choice. Do you want to travel, volunteer, start a small business, raise grandchildren? Your plan must reflect your dreams. 2. Beware of scams and incompetence. Older individuals are frequent targets of investment fraud or poor advice. Even well-meaning advisors can be unqualified. Always ask questions, demand transparency, and never invest in something you don't fully understand. Chapter 18. Going Further with Stocks, Deep Explanation. As investors grow more confident with basic concepts, they naturally start exploring more sophisticated tools and techniques in the stock market. This chapter is a bridge between foundational investing and more advanced strategies. It covers various essential topics that serious investors need to understand before moving beyond mutual funds or index funds and into the complex world of individual stock investing. 1. Preferred stocks. Fixed income with equity characteristics. What are preferred stocks? Preferred stocks, often denoted as PF, are a class of ownership in a company that has characteristics of both stocks and bonds. Like bonds, they typically offer fixed dividend payments, and like stocks, they represent a share of equity. Key characteristics: priority in dividends. Preferred shareholders are paid dividends before common shareholders. Fixed dividend rate. Example: a $50 preferred stock with a 10% yield pays $5 annually, regardless of company profit growth. Stable price range. The price fluctuates primarily due to changes in interest rates, not company performance. Callability. Many preferred are callable, meaning the issuing company can repurchase them at a preset price, which introduces reinvestment risk. Convertibility. Convertible preferred can be exchanged into common stock. These are attractive because they combine fixed income with potential equity growth. Caution: high-yield preferred, example 15% to 18%, often signal distressed companies' buyers take on high risk. Preferred get paid before common shareholders but after bondholders, making them middle tier in claim priority. Investor insight: preferred suit those seeking regular income, but they're not ideal for growth-focused investors, unless they're convertible preferred, which offer a hybrid benefit. 2. Odd lots: buying less than 100 shares. Definition: an odd lot is any number of shares less than 100. Brokers prefer trading in round lots, multiples of 100 shares, but buying smaller amounts is completely acceptable for retail investors. Why it matters: odd lots may incur slightly higher transaction costs. Still, they're useful for new or small investors testing a company or entering expensive stocks. Example: buying 10 shares of IBM at $120 is equal to $1,200 versus $12,000 for 100 shares. Investor insight: odd lots democratize investing, allowing broader access to expensive stocks. There's no shame in starting small. 3. Stock prices and stock splits. Stock prices: a stock's price isn't a direct reflection of the company's value. For example, IBM at $120 not equal to 3x, more valuable than GM at $40. Companies choose a price range for their stock for strategic reasons: liquidity, investor psychology, etc. Stock splits: a 2-for-1 split turns 100 shares at $120 into 200 shares at $60. It does not change your investment value, but it increases liquidity, more shares available, makes shares affordable to new investors, often signals company growth and success. Reverse splits: a company may issue 1 share for every 2 or more, increasing price per share. Usually, a red flag companies do this to remain listed on exchanges. Quart: ex-dividend status, meaning a stock goes ex-dividend about a week before the dividend is paid. If you buy during this period, you won't receive the upcoming dividend. Impact: the stock price drops by the amount of the dividend on the ex-dividend date. Example: if dividend is equal to $1 and price was $50, then price becomes $49 when it goes ex-dividend. 5. Limit orders and stop orders. Controlling the trade. Limit orders: you set the maximum price to buy or the minimum price to sell. Buy limit order: buy 100 shares of AT&T at no more than $35. Sell limit order: sell only if AT&T hits $40. Can be a day order or good till canceled, GTC. Stop orders. Stop loss orders: you set a trigger price to sell if the stock drops to a certain level. Example: bought at $35. Stock rises to $42, set stop order at $40 to lock in gains. Protection from loss, but not guaranteed. If the stock crashes suddenly, you may sell for even less than the stop price. 6. Selling short. Profiting from decline. Concept: you borrow shares to sell at a high price, hoping to buy them back at a lower price later. How it works: broker borrows shares for you. You sell them now at $100. Later, you buy back at $70 if price falls. You return the shares and keep $30 profit. Risks: unlimited loss potential. If the stock rises instead of falling, you must pay any dividends the lender would have received. Requires a margin account and incurs interest costs. 7. Margin accounts. Borrowing to amplify gains and losses. What is margin? You borrow money from your broker to buy more stocks than you could with cash alone, using your holdings as collateral. Basic math: own $10,000 in stock. Borrow $10,000 more on margin. Now control $20,000 in stock. Pros and cons: higher potential gains. If stock rises 25%, your leveraged portfolio gives better returns. Greater risk: if stocks don't rise, you still owe interest on borrowed funds. Example: buying on margin. Starting point, your own investment. Imagine you have $10,000 of your own money, and you decide to invest in General Electric, GE, stock. You open a margin account with your broker, which allows you to borrow money to buy more stock than you could with your cash alone. In this case, you choose to borrow an additional $10,000 from your broker, bringing your total investment to $20,000 worth of GE stock. Here's what just happened. You own $10,000 worth of GE stock with your money. You buy another $10,000 worth of GE stock with borrowed money. Total GE stock you now hold, $20,000. But this isn't free money. The broker charges interest on the $10,000 you borrowed, let's say 10% annually. Year 1. The stock doesn't move. Suppose the stock doesn't go up or down during the first year. The value of your total holding stays the same at $20,000. However, you owe 10% interest on the borrowed $10,000, which is $1,000 for the year. Since the value of your stock hasn't changed, you haven't gained anything, but you're now down $1,000 because you had to pay interest out of your pocket or from the cash in your margin account. So, after 1 year, your stock is still worth $20,000. You owe $1,000 in interest. Your net equity, your share, has now dropped from $10,000 to $9,000. Even though the stock didn't lose value, you're at a loss because of the borrowing cost. This is the hidden risk of margin. The clock is ticking even if the stock doesn't move. Year 2. The stock finally rises. Let's say you decide to hold on for another year. This time, GE stock performs well and goes up 25% in value. Your $20,000 worth of GE stock is now worth $25,000. You still owe the original $10,000 loan. But now, across 2 years, you've paid a total of $2,000 in interest, $1,000 per year. Let's figure out what you have now. $25,000, your total stock value, minus $10,000, the loan you have to repay. That leaves you with $15,000. Now subtract the $2,000 you paid in interest over the 2 years. $15,000 minus $2,000 is equal to $13,000. So your original $10,000 has grown to $13,000. That's a $3,000 profit. Compare with no margin. What if you had not borrowed money and had only invested your own $10,000? Well, if the stock went up 25%, then your $10,000 would have become $12,500. That's a $2,500 profit. So yes, by using margin, you made $500 more in profit. But you also took on more risk and had to commit to at least 2 years of interest payments. So what's the big lesson here? Margin amplifies your gains, but it also amplifies your risks. For it to be worthwhile, the stock has to go up more than the interest you're paying, and that's usually at least 10% per year. If the stock stays flat, or even dips a little, you still owe the interest, and you could easily end up losing money, even when your stock technically hasn't lost any value. Think of margin as a lever. It can lift you higher, but it can also crush you if things turn against you. That's why margin investing is best used by experienced investors who have done their homework and are confident in the stock's future growth, and who are prepared for things not going as planned. 8. Margin calls, a dangerous trigger. What is a margin call? If the value of your collateral, stocks, drops, the broker may demand additional cash or securities to restore the 50% margin level. Example: buy $20,000 stock with $10,000 margin. Stock drops to $12,800. Broker demands $6,400 total equity, 50% of $12,800. You only have $2,800 need to bring in $3,600 more. If you fail to act, broker will sell your stocks, potentially at a loss, to protect the loan. 9. The 1929 crash. Margin run amok. In 1929, investors could borrow up to 90% of the stock's value. When prices dropped, collateral value collapsed. Margin calls flooded in. Investors sold en masse to cover debts. Selling pressure crashed the market further, a vicious cycle. This historical lesson explains why modern regulations limit margin borrowing to safer levels. Example 50%. 10. Using stocks as collateral for loans. Beyond margin investing, you can borrow against your securities for personal loans. Brokerages often offer debit cards or check writing tied to your account. This makes borrowing too easy, potentially leading to overextension. If your stocks fall in value, you get a margin call for personal loans too. Safe practice tip. Borrow only half of your margin limit. If your portfolio is worth $10,000, borrow no more than $2,500. This buffer reduces the risk of margin calls in normal market volatility. Chapter 19. Buying Methods. Investing isn't just about what you buy. It's how you buy that can make or break your success. In this chapter, we delve into a range of buying methods that have proven useful to investors over time. But before jumping into techniques, we start with a revolutionary theory that shook the foundations of Wall Street: the random walk theory. The random walk theory, a bombshell in Wall Street's playbook. In 1973, economist Burton Malkiel released a book titled A Random Walk Down Wall Street, which delivered a deeply unsettling message to traditional investment professionals. The stock market is so efficient at processing information that stock prices already reflect all known information. According to Malkiel's random walk theory, trying to beat the market by carefully selecting stocks or relying on professional advice is often no better than random selection, like having a monkey throw darts at the stock listings. His argument rested on the concept of the efficient market, that all public information about a stock is immediately absorbed and reflected in the stock's price. Thus, by the time most investors hear good or bad news, the opportunity to profit has already disappeared. Malkiel backed up his theory with data showing that the S&P 500 index outperformed two-thirds of professional fund managers during the 1970s and 1980s. Implication for the individual investor. This was a seismic shift in how people thought about investing. If stockbrokers and fund managers consistently fail to beat the market, then why pay them fees at all? For many individual investors, the better choice is to invest in index funds that mirror the broader market. Still, not everyone agrees with Malkiel. While he believes in market efficiency, even he acknowledges there are exceptions, especially among expert newsletter writers or investment authors who have a track record of outperforming the market. That brings us to the heart of this chapter: buying methods that, when practiced with discipline and wisdom, give individual investors a fighting chance at beating the averages. To dollar-cost averaging, turning volatility into an ally. At its core, investing is about buy low, sell high. But in real-time markets, knowing when you're at a high or a low is almost impossible. Enter dollar-cost averaging, a method that sidesteps timing altogether. How it works. You invest a fixed amount of money at regular intervals, say $500 every month, regardless of the stock or fund price. When prices are low, your fixed amount buys more shares. When prices are high, it buys fewer. Over time, this smooths out the effects of market volatility and lowers your average cost per share. Example: let's say a mutual fund fluctuates throughout the year. You invest $500 each month. In January, the share price is $12. You buy 41 shares. In August, the share price is $8. You buy 62 shares. In December, the share price is back to $12. You now own 550 shares. Had you invested the full $6,000 in January at $12, you would have gotten 500 shares. But using dollar-cost averaging, you ended up with 550 shares, worth $6,600 at year-end. You made a $600 gain, even though the fund's price didn't increase. Why this method works: reduces the risk of investing at the market peak, makes investing habitual and disciplined, ideal for new investors with limited capital, Perfect for IRAs, especially with no-load mutual funds. Exploits market dips, turning volatility into a benefit. Bonus tip: statistically, prices tend to dip around the 20th of the month when institutional selling occurs. Investing around this date can give you a minor long-term edge. 2. Fundamental analysis: understanding a company's true worth. If dollar-cost averaging is about method, fundamental analysis is about valuation. It involves diving into a company's balance sheet, income statement, market position, industry strength, growth prospects. You're not just looking at the stock's price. You're looking at whether the business itself is healthy, growing, and durable. Fundamental analysis assumes that over time, good companies will be recognized by the market, and their stock prices will rise accordingly. It's best suited for long-term investors who want to build confidence in what they own. 3. Technical analysis: riding the waves of momentum. While fundamental analysis is about the company, technical analysis is all about the stock itself. Instead of studying financial statements, technical analysts ask, is the stock being heavily traded? Are large institutions buying or selling? What does the price chart look like? Are there volume spikes, patterns, or breakouts? This method is more about market psychology than company performance. It tries to time the market, identifying when a stock, or the whole market, is likely to move up or down based on behavior patterns. Technical analysis is often used by short-term traders, but some long-term investors use it to fine-tune entry and exit points. 4. Low-priced stocks: high risk, high reward. Low-priced doesn't just mean cheap. It refers to small companies with potentially high growth prospects. We're not talking about collapsing giants like Pan Am post-bankruptcy. We're referring to emerging companies, the Apples or Amazons of tomorrow. Why investors like them? Small-cap stocks have historically outperformed large-cap stocks. Percentage gains can be dramatic. A 75C stock doubling to 150 is a 100% gain. You can buy more shares for less capital, increasing leverage. But be warned: higher volatility and uncertainty, lower trading volume, harder to buy or sell quickly, more vulnerable to market swings, sometimes less regulatory oversight. If you choose to invest in small companies, stick to listed exchanges or NASDAQ. Diversify across at least 6 different companies. Don't allocate more than 10–20% of your portfolio to them. Use newsletters or personal research for ideas. The reward can be great, but only if you accept and manage the risk. 5. Contrarian investing: the art of going against the herd. Contrarianism is about doing the opposite of what everyone else is doing. While the crowd is chasing the hottest stocks, the contrarian is quietly buying overlooked, underpriced, or unpopular companies with strong fundamentals. Examples of contrarian thinking: buying small company funds in 1990 after years of underperformance. They went up 30–50% in 6 months. Investing in unnoticed companies with clean balance sheets and growth potential, even if they're not in the headlines. The psychological barrier: contrarian investing is emotionally hard. When you go against the herd and fail, you fail alone. It takes courage, independent thinking, and deep research. But historically, contrarian investors have often outperformed others. Avoiding the trap: overmanaging your portfolio. Just as neglecting your investments can be harmful, overmanaging them can be even worse. Constantly watching stock prices and reacting to small changes can lead to panic selling, increase transaction costs, derail your long-term strategy. A quality portfolio should be built with patience and a long-term mindset. Market fluctuations are inevitable. What matters is how you respond, not how often you react. In summary, key lessons from Chapter 19. 1. Market timing is hard. Dollar-cost averaging offers a smart, disciplined way to invest regularly and ride out volatility. 2. Fundamental analysis helps you understand a company's real value. Technical analysis helps you understand market momentum. 3. Low-priced stocks can deliver massive returns, but they require careful research and diversification. 4. Contrarian investing often uncovers the best opportunities if you have the courage to act when others won't. 5. Don't micromanage your investments. Quality companies need time to grow. Patience pays. 6. Invest with strategy, not emotion. Chapter 20. Bad Times. Understanding, Surviving, and Growing Through Market Storms. 1. The Shock of Crisis. When markets shake. In early August 1990, the financial world was rattled by alarming headlines. Iraq invades Kuwait. Oil prices soar. Dow loses 300 points. These headlines weren't just media noise. They reflected a genuine jolt to global stability. The Dow Jones Industrial Average, a barometer of market confidence, had recently touched 3,000 points in July, but within weeks, it lost 20% of its value. And that was just the average. Smaller stocks were hit even harder, plunging 30%, 40%, even 50%. The psychological effect on investors was devastating. But it wasn't just stocks. Real estate, too, began to decline. This was especially painful for those who had only ever seen home prices rise. Young property owners who had believed real estate only went up were learning the hard truth. All markets cycle. 2. The investor's dilemma. What should you do in a downturn? When the market tumbles, the most common reaction is fear. Many investors sold in panic, often at the bottom, locking in their losses. Ironically, many of these people had only recently entered the market, afraid of missing out during the summer rally. They bought high and sold low. This is the classic mistake that every investor is warned against. But when headlines scream war and recession, when experts predict another Great Depression, the temptation to get out before it gets worse is overwhelming. Some advisors recommend selling early and then buying back at the bottom. Others urge investors to hold steady, not to sell into fear. Who's right? 3. Historical context. Are today's bad times as bad as yesterday's? Since the end of World War II, there have been multiple recessions and 14 major bear markets. But here's what's crucial. Despite looking grim in the moment, most of these downturns were milder than expected, and recovery always followed. Why? Because today's economic systems are smarter. Unlike the 1930s, modern governments and central banks have powerful tools. Fiscal and monetary policies to stimulate the economy. Central banks can lower interest rates. Governments can spend on infrastructure or provide stimulus. These tools didn't exist or weren't understood in the past. So while economic fears persist, and rightly so, they're less likely to spiral into collapse. 4. War and wealth. The myth of wartime prosperity. There's a persistent myth that war is good for the economy. But in the modern world, war is more often an economic drag than a boost. Why? War disrupts global trade, especially energy. It diverts capital away from productive sectors, like consumer goods or tech, into military spending. Modern defense budgets are already massive, so more spending simply increases debt. The U.S. has carried the weight of Cold War military costs for decades. In contrast, nations like Germany and Japan, which spend much less on defense, have experienced faster economic growth. Investors know this. When the 1991 Gulf War appeared to be ending, the stock market surged. Why? Peace promotes prosperity. 5. Why the market moves, it's not just economics. A stock market crash is rarely the result of pure economic data. In fact, it's often about perception. Markets don't just react to facts, they react to what investors believe others will do. This is why rumors can cause massive moves even when there's no real change in fundamentals. One trader's panic can cause a ripple effect, turning into a wave of selling. This feedback loop is self-fulfilling. If enough investors think prices will fall, they sell, and prices do fall. That's how the market works. It's like army ants marching through the jungle. There's no leader, Each one moves because the one behind is pushing. At times, the market may behave completely irrationally. For example, bad economic news can cause the market to rise because investors expect interest rates to be cut in response. Great company earnings might cause a stock to drop because traders expected even better results. So understanding the stock market is not just about economics, it's about psychology. 6. The flow of capital. Where does the money go? When the stock market falls, where does all that money go? It doesn't disappear. It flows into safe havens, savings accounts, government bonds, money market funds, foreign currencies, sometimes real estate or commodities. Eventually, when fear subsides and economic data improves, investors move money back into stocks. This re-entry is delicate. Everyone is watching everyone else, waiting to see who will jump in first. Once the buying starts, prices rise and momentum builds, just like before. The cycle restarts. 7. What's the strategy? A. Buy and hold. The long-term approach. Over the long term, the buy and hold strategy has proven superior. The key is to spread your investments across different types of assets: stocks, bonds, real estate, cash equivalents. Some of these will go down during a recession. Others may hold steady or even rise. A balanced portfolio, like the one discussed in Chapter 15, helps cushion the impact of downturns. Be adjusting risk, not abandoning ship. If you feel compelled to act, adjust your portfolio slightly. Shift from high-risk stocks to safer bond funds. Reduce exposure to small company stocks. But don't sell everything you risk missing the recovery. The market's biggest gains often come right after a crash, when the mood is still gloomy. If you're out of the market then, you miss the bounce. 8. Real estate, a different kind of ride. Unlike stocks, real estate is not liquid. You can't easily sell a house overnight. That's why real estate is inherently a buy-and-hold investment. To protect yourself, buy property you can afford to hold long-term. Avoid needing to sell during market downturns. Plan for worst-case scenarios: job loss, rising rates. If you ride it out, history shows that real estate always recovers. 9. The paradox of the market. When bad news is good. Suppose news is bleak. Unemployment is rising. Spending is down. Corporate earnings are weak. Suddenly, the stock market goes up. Why? Because investors anticipate government intervention like a rate cut from the Federal Reserve. Cheaper money means more borrowing and more spending, which boosts the economy. In this way, bad news today may suggest good times tomorrow, making stocks rise. It's confusing, but that's the world of investing. 10. Emotional resilience. Think like an investor, not a trader. Let's say you bought shares in International Widget Software. You're up 25%. Then earnings come in, up 20%, which is objectively great. But traders were expecting more. The stock drops 15% in a day. Do you panic? No. You remember, you're an investor. You bought based on long-term fundamentals, not hype. The company is sound. Hold on. Ignore the noise. This is how real investors succeed. 11. Conclusion. Awake, aware, and prepared. No one can predict the future. The world may face another war, a debt crisis, or a banking collapse. At the same time, innovation, trade, and recovery are constants in the human story. Your job as an investor is not to predict, but to prepare. Build a diversified, balanced portfolio. Know your plan before a crisis hits. Stay calm during storms. And most of all, stick to your strategy. In bad times, the winners are not those who flee in panic, but those who stay the course with clarity, courage, and preparation. Chapter 21. Bonds, a deep explanatory guide. Introduction to bonds. A bond is fundamentally a loan. When you purchase a bond, you are lending money to an entity, either a corporation or a government, in return for regular interest payments, also known as coupon payments, and eventual return of the full amount you lent, called face value or par value, when the bond matures. Bonds are sometimes called fixed income securities, debt securities, debentures, debt instruments. These different names reflect their technical characteristics, but essentially they all refer to the same concept. You become a creditor, not an owner like you would when buying stocks. 1. Corporate bonds. What they are. Corporations can raise funds by either issuing stock, equity, or borrowing money by issuing bonds, debt. Corporate bonds are typically sold in $1,000 denominations and may be bought at issuance, primary market, on the open market, secondary market, debenture bonds. Most corporate bonds are debentures, which means they're unsecured. They aren't backed by physical assets like real estate or equipment. Instead, they rely solely on the financial strength and creditworthiness of the issuing company. Risk and return. Top-rated corporate bonds, CHO AAA, historically yield 6%, 8%. Higher returns than government securities, but slightly more risk. Maturity. Typically ranges from 1 to 20 years. 2. U.S. government securities. Government-issued bonds are known for safety and liquidity. These include Treasury bonds, T-bonds, long-term 10 to 30 years. High safety, but lower returns. Denominations, $1,000 to $1 million. Exempt from state and local taxes, but not federal. Treasury notes, T-notes. Medium term, 2 to 10 years. Trade on secondary market. Affected by interest rate movements. Treasury bills, T-bills. Short term, 3, 6, or 12 months. No traditional interest. Sold at a discount. Example, buy at $9,400. Receive $10,000 at maturity, $600 return. Advantages, highest safety, virtually no default risk. Very liquid, easy to sell. Lower returns than corporate bonds but offer peace of mind. 3. Municipal bonds, munis. Issued by local or state governments to finance public projects like schools, roads, or water systems. Types, general obligation bonds. Backed by tax revenue. Considered safe if the municipality has a solid tax base. Revenue bonds. Fund income-generating projects, e.g., toll roads, stadiums. Riskier since repayment depends on project revenue. Tax advantage. Most munis are tax-free at the federal level. Some may also be exempt from state and local taxes, especially attractive for those in high tax brackets. Risk note. Some cities have defaulted. Review bond ratings before buying. You can reduce risk by using municipal bond mutual funds. 4. Zero-coupon bonds, zeros. Zeros pay no annual interest. Instead, they are sold at a steep discount and mature at full face value. Automatic reinvestment. Interest is compounded and added to the bond value semi-annually. Great for long-term growth or college savings. Tax caveat. Interest is taxed annually even though it's not received until maturity. Best suited for tax-deferred accounts like IRAs. Who they attract. Small investors, low price entry. Long-term planners, education, retirement. 5. Convertible bonds. Convertible bonds offer the best of both worlds, bond safety and stock-like upside. Key feature. Can be converted into common stock at a fixed rate. If stock prices rise, bond value increases. If stock prices fall, you still get your regular bond interest. Safety net. Interest is prioritized over dividends. Convertible bond prices track stock prices, but offer some downside protection through fixed interest. Ideal for investors wanting exposure to stock gains with reduced risk. Those seeking balance between income and growth. 6. Junk bonds, high-yield bonds. These bonds pay high interest rates but come with significant risk. The danger. Issued by companies with poor credit ratings. Higher default risk. Very sensitive to economic conditions. 1980s history lesson. Used in leveraged buyouts, LBOs, to fund corporate takeovers. Led to massive corporate debt and increased vulnerability during recessions. contributed to S&L and insurance crises. Risk-reward reality. High yields, 12 to 15%, can be tempting. Default risk and market collapse can destroy portfolios. Not for new investors. Even experienced investors tread carefully. Junk bond mutual funds exist, but carry the same underlying risk. Bond ratings. Who rates bonds? Standard & Poor's, S&P. Moody's? Example ratings. A. Safest. BBB, shot medium grade. BB and lower, SATARS junk status. Ratings can change. A downgrade can reduce a bond's market value. Ratings reflect a company's financial condition and ability to meet interest payments. Pro tip: bond mutual funds with A-rated or better bonds spread risk across many issuers. Diversification shields you from one bond's rating drop, affecting your whole portfolio. Bond market fluctuations. Unlike fixed bank CDs, bond values fluctuate in response to interest rate changes and rating downgrades. Interest rate inverse relationship. When new bonds offer higher rates, older bonds with lower rates lose market value. Buyers demand a discount on older bonds to match new yields. Important concepts. Coupon rate. Fixed interest as a percent of face value. Current yield. Annual interest. Current bond price. Yield to maturity. YTM. Total return. If bond is held to maturity, accounting for premium, discount. How the Fed affects interest rates. Federal Reserve tools. Raises rates, slows economy, fights inflation. Lowers rates, stimulates borrowing, boosts growth. Bond price effects. Rising interest rates, sinnern falling bond prices. Falling rates, rising bond prices. Callable bonds. Corporations may repay early if they can reborrow at lower rates. Bad for you if holding a premium bond. How to read bond tables. 1. Name, issuer. Example, PG&E. 2. Coupon. Interest rate paid. 3. Maturity. Year bond matures. 4. Yield. Current yield based on market price. 5. Vol. Trading volume. In dollars. 6. Last trade price as percent of $1,000 face value. 7. Net CIG, change in price from previous day. Understanding this helps you gauge whether a bond is trading at a premium, 100, or discount, 100, its attractiveness based on interest rates, the bond's market behavior. Final thoughts. Are bonds right for you? Bonds are excellent tools for generating steady income, preserving capital, diversifying a portfolio. They vary widely in risk and return, from the ultra-safe treasury bonds to the volatile junk bonds. The key is alignment with your personal risk tolerance. Summary risk ladder. 1. Treasuries, safe, low return. 2. Municipals, safe plus tax benefits. 3. Corporate bonds, moderate risk, return. 4. Convertibles, equity potential with income. 5. Zeros, long-term growth with no income. 6. Junk bonds, high income, high risk. Chapter 22. Using your computer. In the modern era, where speed, access, and real-time decisions shape investment outcomes, the personal computer, PC, has become a revolutionary tool in the investor's arsenal. This chapter underscores a pivotal transformation in the history of individual investing, the convergence of technology and finance. Let's break it down in layers of deep understanding. The symbiosis of computers and investment. The relationship between computers and the world of investment is not merely convenient, it's transformational. Real-time access. Prior to the digital age, investors had to rely on newspapers, delayed news, or phone calls to brokers for information. Today, with a personal computer and internet connection, investors can track market movements, read expert commentary, and even execute trades in real time, leveling the playing field. Institutional investors have long had access to expensive data feeds, analytical tools, and proprietary models. Now, retail investors, with a modest investment in technology, can access many of the same services: stock screeners, portfolio analytics, and real-time news updates. Speed and efficiency. The speed of data retrieval and the ability to transact instantly online reshapes how decisions are made. Where once analysis might take hours or days, now it happens in minutes, and trades are executed in seconds. The information explosion, a double-edged sword. However, with the democratization of financial information comes a new challenge: information overload. Too much data. The Internet has made available an overwhelming volume of financial news, analysis, reports, and opinions. For an investor without a clear strategy, this can lead to confusion, fear, indecisiveness, or impulsive actions. The need for a plan. The chapter warns us, before diving into the digital sea of data, define your investment framework. Ask yourself, are you focused on mutual funds or individual stocks? What level of risk are you comfortable with? Are you looking at short-term trading or long-term value investing? Once you know what kind of investor you are, only then can you use online tools effectively and selectively. What's available online and offline? You don't need to be connected to the Internet to begin organizing your financial life. The personal computer, even offline, offers offline tools, personal finance software. Quicken, Microsoft Money, and others allow you to track spending, income, debts, and savings goals. Investment tracking software. Programs can track the performance of your portfolio, simulate future scenarios, and generate charts and analysis. Stock screeners and simulators. Some software and CD-ROM databases let you test investment strategies with historical data. A valuable feature for learning and refining approaches. Online tools. When you go online, the capabilities expand dramatically. News and research portals. Access to premier business journalism. The New York Times, Business Week, Reuters, and Investors Business Daily. At your fingertips. Real-time market data. With tools like quotes and portfolios, you can monitor current price, even with a short delay, daily highs and lows, volume of trades, 52-week trends, forums and communities. Interactive platforms like those on AOL or newer platforms like Reddit or StockTwits allow you to discuss stocks and strategies with peers and even professionals. Mutual fund analysis. Services like Morningstar offer comprehensive performance reviews and management insights. Perfect for mutual fund investors. Simulated trading platforms. Ideal for beginners. Practice risk-free, build confidence, and test different strategies without financial consequences. The beauty of this ecosystem is customization. You use only what aligns with your goals and experience. A half hour that changes everything. A use case. Imagine a 30-minute session on America Online, AOL, one of the pioneers of digital investing platforms in the 1990s. Financial news. First, you catch up with updates from top-tier publications and newswires. Check your portfolio. You input stock symbols and instantly review performance metrics. Investigate a drop. You notice a stock like Cisco Systems is falling. With a click, you find breaking news explaining the dip. Join a discussion forum. Experts and fellow investors debate the news. You read, reflect, and decide. To hold, not sell. Explore a mutual fund. Through Morningstar, you research Scudder International Fund, its historical performance, and recent shifts. Global context. You track the European markets via Reuters to see if global trends support the fund's decisions. All in 30 minutes, and you've conducted fundamental analysis, technical review, peer consultation, and macroeconomic research. Is being online essential? No, but it depends on your goals. If you're a low-involvement investor, you stick to mutual funds. You review performance monthly. You prefer traditional methods, books, periodicals, phone calls. In this case, you don't need to be online. You can be a successful investor without logging in. Many still are. If you're a moderately involved investor, you want to track fund performance more frequently. You enjoy learning and researching. You want to customize your portfolio. Here, being online adds value. The ability to compare, analyze, and adjust your investments is greatly enhanced. If you're an active investor or trader, you invest in individual stocks, ETFs, or options. You need real-time updates, low-cost trades, and fast execution. Then, being online is non-negotiable. Without it, you will miss opportunities and fall behind. Final thoughts. Navigating the information age as an investor. Computers, especially when connected online, are powerful allies, but only when used with a clear purpose and discipline. Without a plan, the sheer volume of available tools, data, and opinions can paralyze you. The smart investor of today must filter noise from signal. Use technology to reinforce a thoughtful strategy, not to chase hype. Combine the wisdom of traditional investing with the efficiency of modern tools. Part 3. High-risk investing. The final part explores advanced speculative areas such as options, futures, commodities, collectibles, and startups. It explains how these markets work and who they are best suited for. Purpose: to educate readers on the potential rewards and significant risks of aggressive investing. It's meant for those who are ready to explore beyond traditional methods with caution and awareness. Chapter 23. Investing in yourself. Starting your own business. Starting your own business may be one of the most exhilarating and deeply personal financial decisions you ever make. It's the boldest expression of self-investment, where the investor is the enterprise. But with that excitement comes uncertainty, risk, and a need for clarity. This chapter guides the reader through a disciplined, deeply reflective journey into the idea of entrepreneurship, not as a fantasy, but as a strategic commitment of capital, time, and life energy. 1. The illusion and the reality. The chapter opens by confronting a common romantic notion. Starting your own business equals freedom, wealth, and doing what you love. This seductive vision whispers promises of autonomy, purpose, and riches. But reality is more demanding. Being your own boss sounds appealing, until you realize you're the one who must worry about everything. Sales, staffing, marketing, payroll, customer complaints, and legal compliance. Business ownership is not a vacation. It's a high responsibility, full commitment role that often leaves little room for relaxation. It may offer freedom of direction, but not freedom from effort. Most importantly, just because you love something, example cooking, doesn't mean you'll love running the business built around it. Example, managing restaurant staff, negotiating leases, or doing inventory. The dream, if not grounded in reality, can become a nightmare. 2. Two fundamental questions for every entrepreneur. Before you invest a single dollar in a business, you must answer two core questions. These aren't casual questions. They are filters that separate momentary impulses from well-grounded ambition. Question 1. Why do you want to start a business? This question cuts deep. Are you seeking security? Freedom from a boss? More money? If so, you're likely heading toward disappointment. Why? Security is a myth in entrepreneurship. Most new businesses fail. This is a risky venture, not a safe one. Freedom is misleading. Entrepreneurs often work longer, harder hours than employees. The flexibility is often a myth. Money may come, but only after years of discipline and sacrifice. And even then, only if you scale, manage efficiently, and avoid costly mistakes. The only solid reasons are, you truly want to do the work your business will involve. You enjoy the multitasking, hustle, and creative energy that come with building something from scratch. Without these core motivations, it's wiser to invest in something else. Question 2. How much money can you afford to invest, and is it enough? This question gets into the gritty side of financial planning. It reminds us that a business can rapidly drain a portfolio. It can demand more and more capital before any profits are visible. Many stories glamorize the entrepreneurs who risked everything and won, but there are far more who risked everything and lost. So you must define your peace of mind money, savings that cannot be touched under any condition. Build a plan B. What will you do if the business fails? Can you re-enter your profession? Can you keep paying rent or your child's school fees? Planning for failure is not pessimism, it's realism. Smart entrepreneurs always carry a parachute. 3. Entrepreneurship is a skill, not a mystery. Once you're clear on your motivation and money, the next stage is skill building and planning. Like investing, entrepreneurship is a learnable discipline. It's not about genius or luck. It's about effort, learning, and adaptability. The chapter outlines 3 essential steps to begin. Step 1. Immerse yourself in entrepreneurial culture. Learn from those who've done it. Read magazines like Inc. and Entrepreneur. Read books. Listen to podcasts. Most importantly, talk to real entrepreneurs. Their war stories and wisdom are more valuable than motivational quotes. Step 2. Learn everything about your industry. You cannot start a travel agency just because you love traveling. You need to understand the supply chains, the profit margins, the competitors, customer pain points, industry trends. If you haven't worked in the field, get a job in it first. Experience, even at an entry level, gives you practical knowledge and credibility. Step 3. Write a business plan. This is your blueprint. It forces you to answer questions that reveal the business's true viability. What exactly are you selling? Who will buy it and why? How will you market it? How will it generate revenue? What are your costs, timelines, and milestones? Once written, share it with experienced people friends, accountants, business mentors. Let them poke holes. Better they do it now than the market later. 4. Capital, where the money comes from. Starting a business requires capital, but getting it isn't always easy. Here's a look at the main sources and the truths behind them. Venture capital, mostly a myth for beginners. VCs invest in businesses with massive growth potential and proven management teams. Unless you're starting the next Google, this door is probably closed. Bank loans, often difficult for new businesses unless you offer collateral or personal guarantees. Some governments, like the US SBA or Indian MSME schemes, provide support, but it's a complex process. Friendly money. This is the most likely source: family, friends, or acquaintances. But beware. Be clear. Are they investing or lending? Put it in writing, reviewed by a lawyer. Keep them updated. Misunderstandings can destroy relationships. Angel investors. Wealthy individuals who invest in startups for fun or passion. They are rare but real, often found through networking, local business events, or industry insiders. 5. Buying a business versus starting from scratch. Buying an existing business can be a smarter path, especially if the business is profitable and established. You understand the industry. You see ways to improve it. Case in point, Ernie and Jim, experienced natural foods workers, bought a small store with a state-backed loan. They knew the business inside and out. With their improvements, it became even more successful. This strategy reduces startup uncertainty and lets you hit the ground running. 6. The dangers of shallow motives. Author Paul Hawken emphasizes that many businesses fail not because the idea was bad, but because the intent was shallow. For example, someone starts a video rental store because video stores are hot, but lacks any real passion or understanding. Your business should come from a deep place, a vision, a conviction, a passion, not from surface trends or envy. 7. Treating family money like investment capital. If parents or friends invest in your business, treat them like professional investors. Clearly define their stake or loan terms. Explain the risks. Report progress honestly. A handshake is not enough. Miscommunications can devastate family bonds. Professionalism is a sign of respect. 8. Dreams plus planning. Jot, powerful combination. The final note of the chapter is both poetic and practical. Dreams matter. Enthusiasm matters. Optimism matters. But none of them are enough. Planning is not the enemy of dreams, it is their protector. Planning grounds your vision. It tests it, sharpens it, and gives it a real chance of surviving in the real world. Businesses that succeed balance passion with process, dreams with discipline. That balance is the formula, not a guarantee, but the best shot you can take. Chapter 24. Caveat emptor. Let the buyer beware. A deep explanatory commentary. Introduction. A world of illusions and promises. The Latin phrase caveat emptor, meaning let the buyer beware, serves as a profound warning, particularly in the world of investing. This chapter explores the seductive charm of can't-miss systems, market myths, and shady investment pitches that promise quick riches with little risk. The author unpacks these traps in a deeply educational way, offering a crucial truth. The most dangerous thing in investing is not the market itself, it is the investor's illusions about the market. Part 1. Super Bowls, Skirts, and Pseudoscience. The chapter opens with humorous yet poignant examples of irrational correlations. The Super Bowl theory, which predicted market performance based on which football league won, had a surprisingly good record until it didn't. Hemline theory suggested that when women wore shorter skirts, the market would go up. Again, correlation without causation. These anecdotes are not just quirky distractions. They expose a key vulnerability of human psychology. Our brain craves patterns, even where none exist. Many investors get lured into believing such pseudo-predictive models because they want certainty in an uncertain world. But this longing often makes them susceptible to irrational beliefs and poor decisions. Part 2. The Sales Machine. Systems, ADS, and Hype. The author recounts first-hand experience with investment sales pitches and ads promising 230% profit in 1 year. Easy to execute. Unbeaten in 20 years. Even smart investors can fall for this. These offers sound logical, appear data-driven, and always appeal to the dream of effortless wealth. But when scrutinized, they reveal flaws, such as A. Selective backtesting. Many of these systems are based on historical data cherry-picked to make the system look foolproof. But markets are dynamic. A system that worked in the last decade may fall apart in a downturn. B. Too good to be true. If a system is so reliable and profitable, why would anyone sell it for $3,000? The real reason is that the system's creator profits not from using it, but from selling the hope it represents. C. Psychological manipulation. Salespeople use scarcity. Act now. Social proof. Others are making a killing. And guilt. Don't miss out. To push unprepared investors into action. The less experience you have, the more susceptible you are. Lesson. If you don't understand the investment, you're gambling, not investing. Part 3. The greatest danger. You and your beliefs. Here's the real trap. The belief that you can get rich quickly with minimal risk. This belief is what makes you vulnerable to all the slick systems, false promises, and market timing schemes. It's not just a lack of information that hurts investors, it's misinformation, illusions, and irrational confidence. This illusion is reinforced by media coverage of lucky success stories, friends sharing only their wins, not their losses, survivorship bias, where only the winners' stories are visible. Case study, the 1987 crash. After the market crash of 1987, suddenly everyone claimed they had predicted it. The implication? If you missed it, you were foolish. But hindsight bias distorts truth. The real cause wasn't a handful of smart people. It was collective panic. Part 4. Bad brokers. Churning. Conflicts and misplaced trust. The author warns not just about systems and ads, but also certain full commission brokers who may not have your best interests at heart. Some brokers churn accounts, encouraging frequent trades to earn commissions. Recommend hot tips unsuited to your personal goals or risk tolerance. Promote stocks their firm is making a market in, without disclosing conflicts. How to protect yourself. Know your broker's incentives. If they earn more by having you trade more, question their advice. Demand transparency. If they recommend a company their firm represents, you deserve to know. Arbitration is available. Most broker-client agreements allow you to challenge misconduct through fair arbitration panels. Still, the best protection is knowledge and vigilance. Part 5. Market timers. The promise of perfect predictions. Market timing is the practice of switching in and out of investments based on predictions of market highs and lows. While theoretically sound, very few investors or professionals have successfully timed the market consistently. Even fund managers who try to time the market often underperform broad indexes. The risks of market timing include missing rebounds if you exit too soon, frequent switching penalties, now imposed by many mutual funds, emotional decision-making fueled by fear or greed. Yet, market timing continues to appeal to those seeking control in a volatile environment. And for experienced investors, some moderate market timing, like reducing small-cap exposure before a predicted bear market, can be reasonable. But for most, a disciplined buy-and-hold strategy remains safer and more effective. Part 6. Gambling vs. Investing. The final and most sobering warning. Many new investors aren't investing. They're gambling. When inexperienced investors chase futures, junk bonds, options, or untested systems with dreams of fast profit, they're not using analysis. They're rolling the dice. The author advises, if you're looking for thrills, go to Vegas. Keep your capital intact. The real challenge in today's market isn't growing money fast, but preserving it with intelligent risk-taking. Why these risky areas are included. To educate. Even if you're not ready for futures or collectibles, understanding them is important. To protect. Salespeople often target new investors. Understanding their tactics is your first defense. To prepare. One day, you may need or choose to venture into these markets, and forewarned is forearmed. Conclusion. Wisdom, not wishful thinking. The real message of Chapter 24 is a psychological one. Most investment mistakes begin in the mind of the investor. Believing in magic systems, fast returns, and foolproof strategies is a product of wishful thinking, not wisdom. Just as we are tempted to believe in horoscopes, lucky numbers, or patterns in randomness, we are also tempted to believe we can beat the market without understanding it. This is where the greatest danger lies. Investing is not a get-rich-quick game. It is a methodical process of placing your money in environments where risk and reward are balanced, and where your decisions are based on knowledge, not hope. Chapter 25. Precious Metals, Rare Coins, and Other Collectibles, a Deep Explanation. 1. Gold, the ancient obsession with diminishing returns. Gold has long captivated the human imagination. Its allure is not just financial, it's mythological, cultural, and psychological. In stories, it was the ultimate prize, the dragon's hoard, the king's treasure, the buried chest under the witch's hut. This emotional resonance leads many modern investors to feel they should own gold, even if the numbers don't fully support it. A. Historical role of gold. Gold has traditionally served as a store of value during times of economic upheaval, a hedge against inflation and currency devaluation, a universal medium of exchange, independent of any single country's economy. For centuries, this made sense. Gold doesn't corrode. It's rare. It's recognized globally. And before paper currencies were trusted, gold was money. B. Why gold lost its shine in recent decades. By the 1990s, gold had lost much of its historical luster as an investment. Several key reasons explain this. Tamed inflation. The high inflation of the 1970s and early 1980s, which pushed gold to $800 OZ in 1980, was brought under control. Gold's appeal as an inflation hedge diminished. Currency hedging replaced it. Sophisticated investors shifted to foreign currencies for hedging. Currencies could be traded instantly by computer, unlike gold, which needed storage and physical transport. Rising supply, flat demand. Jewelry remains the largest use of gold, and unless fashion trends return to gold cufflinks and brooches, demand remains flat. Meanwhile, new mining increased supply. Failure to react during crises. Gold no longer reacted as expected to geopolitical turmoil. For example, during the 1990 Gulf War, gold's price initially spiked, but then fell even amid actual armed conflict. 2. Ways to invest in gold. Despite its weakening performance, gold still attracts attention. There are multiple ways to invest. A. Physical gold, bullion, bars and wafers. You can purchase gold in large bars or small wafers. While romantic, this requires storage and often insurance. Gold certificates. Instead of holding gold, banks issue certificates representing ownership. Easier to store, safer, and equally recognized. Commissions. Buyers typically pay 3 to 10% above market value, which must be recovered through appreciation. B. Bullion coins. Government-minted coins, like the American Eagle. These are tied to gold's market value and easier to trade than bars. Commissions are slightly lower 2% to 4%. C. Gold mining stocks. These offer a speculative way to invest in gold. A successful mine can dramatically increase stock price. However, they're risky. Poor company performance can drag down the stock, even when gold prices rise. D. Gold mutual funds. These diversify risk by investing in multiple gold mining companies. Still risky, but slightly more stable than individual mining stocks. E. Gold futures. Highly speculative and complex, futures let you bet on gold's price without owning it. This combines two high-risk elements, a volatile commodity and leverage trading. Not recommended for beginners. 3. Silver, the understudy of gold. Silver shares many characteristics with gold: historical use, emotional appeal, decorative value, but it's more volatile and even less favored by investors today. A. Why silver struggles. Historic lows. For years, silver has hit historic lows and then dropped even lower. Oversupply, more silver is being mined. Low industrial growth. Industrial and jewelry uses aren't growing fast enough. No longer a hedge. Investors have turned to currencies and other alternatives for safety. B. Ways to invest in silver. Mirroring gold. Bullion. Silver coins. Silver mining stocks. Mutual funds. Futures contracts. Unless conditions change drastically, silver is best appreciated as jewelry, not as an asset. 4. Rare coins. The plastic-encased speculation. Rare coins often appear in advertisements promising market-beating returns, but they come with substantial caveats. A. 3 categories of coins. Bullion coins. Minted for gold, silver investors, e.g. American Eagles. Not rare. Price tracks the metal market. Generic coins. Semi-rare, may be old, pre-1933, lightly circulated. Value partly from metal, partly from collectability. True rare coins. Uncirculated and graded for condition. Value comes from rarity, grade, and collector demand, not metal content. B. Understanding coin grades. Coins are graded 1 to 70 by professional services. MS64, MS66, mint state, are common investment grades. Rarity within grade matters. A coin with a lower population is more valuable. C. The spread and risk. Dealers often charge a 25% spread between buying and selling prices. The coin must appreciate by this much before you break even. The market is heavily promoted, poorly regulated, and often opaque to outsiders. D. Be wary of aggressive sales. Once you show interest, expect many dealer calls. Salespeople are trained to pressure and entice. Learn from independent sources before engaging. 5. Other collectibles: beauty, bias, and bubbles. Collectibles span everything from Elvis albums to Egyptian stamps, with a massive range in volatility, market structure, and emotional attachment. A. What counts as a collectible? Comic books, baseball cards, records, toys, antiques, fine art, stamps, miniatures, dolls, china, silverware, and more. About 70+ recognized categories exist. B. What makes a collectible valuable? Rarity, condition, and desirability. For investment, you need markets that are fluid, i.e., buyers and sellers readily available. A valuable item is useless if no one wants to buy it. C. Dangers of emotional investing. Many beginners get excited about comics or records because they're familiar and understandable. But like with rare coins, dealers often make more than the investors due to wide spreads. Example, a 50 to 100% markup by comic book dealers. D. Collector versus investor. It's important to ask, are you doing this for love or money? Collectors seek enjoyment, personal meaning, and historical interest. Investors want liquidity and return on investment. It's okay to be both, but know which is your priority. 6. Advice for new investors. Don't rush into rare coins or collectibles. These are highly specialized and volatile markets. Start with what you know or love and learn slowly. Research markets and liquidity before making big purchases. Don't believe every ad. Many gurus predict a rise every year. It's only news when they're finally right. Buy low, sell high sounds easy, but understanding why something is priced the way it is and how to find a buyer is where the challenge lies. In conclusion, while gold, silver, rare coins, and collectibles have their place in human history and even investment strategy, they are best approached with caution, knowledge, and clear motivation. For new investors, traditional financial instruments offer far greater predictability, liquidity, and reliability. But for those with genuine interest and patience, collectibles can become both a passion and occasionally a payoff. Chapter 26. Futures, a Deep Explanation. Introduction. The Myths and the Reality. The term futures often conjures images of high-stakes gambling, intimidating financial jargon, and sudden sweeping gains or losses. While it's true that futures markets can be fast-paced and risky, especially for speculators, the popular belief that they are only for cutthroat traders or financial elites is misguided. The concept of futures is rooted not in Wall Street greed, but in agricultural necessity and market stability. At its heart, a futures contract is a simple agreement, a commitment to buy or sell a specific quantity of a good, say corn, oil, or even a foreign currency, at a fixed price on a set date in the future. It is this clarity that makes futures such a powerful tool, not just for speculators, but for farmers, corporations, and global businesses trying to hedge against uncertainty. Part 1. Origins. Futures as a tool of survival. To understand futures properly, we need to go back in time not to Wall Street, but to the farmlands of 19th century America. The problem of uncertainty in farming. Imagine you're a corn farmer in the 1840s. You plant your seeds in spring without knowing what price your corn will fetch in the fall. If there's too much supply, a bumper crop, prices collapse. If there's too little supply, you can command high prices, but only if you've grown enough. This uncertainty makes life chaotic for both farmers and buyers. This is where the futures contract emerged as a savior. A story of the first contracts. Farmer Smith rides into town and offers to sell 200 bushels of corn for 10 cents each, a month from now. The buyer, Frank Middleman, agrees because he knows he can resell the corn at 15 cents per bushel. This agreement, though simple, is the essence of a futures contract, a mutual hedge against future price volatility. Soon, a speculator named Joe Sharp enters the picture. Joe offers to buy the corn from Frank for 14 cents, betting that corn prices will rise even higher. This transfer of contract adds another layer to the transaction, but doesn't change the underlying purpose. Shifting risk from those who cannot afford it, Frank, to those who are willing to accept it, Joe. Part 2. How futures work. Basic mechanics. A futures contract is a legally binding agreement between two parties. The buyer agrees to receive and pay for a commodity at a future date. The seller agrees to deliver that commodity on that date. These contracts are traded in standardized formats, e.g., 5,000 bushels of corn, and they are highly liquid, meaning they can be bought or sold multiple times before the delivery date. Terms to know: go long, take a position to buy the asset in the future. Go short, take a position to sell the asset in the future. Margin, an initial deposit required to enter the contract. This is not a loan, but a good faith security. Mark to market. Daily profits and losses are calculated and adjusted in your margin account. Hedgers versus speculators. Hedgers use futures to reduce or eliminate risk. A farmer locks in a selling price. A baker locks in a buying price for grain. Businesses use futures to protect their operational costs. Speculators like Joe Sharp aim to profit from price movements. They do not intend to deliver or receive the actual commodity. Part 3. Modern use cases beyond corn. The principles of futures trading have extended far beyond agriculture. Today, you can trade contracts on precious metals, example gold, silver; energy, example oil, natural gas; currencies, example dollars, euros, pounds; financial indexes, example S&P 500; interest rates. Let's take a modern example. Hedging foreign exchange risk. Suppose you're a U.S. business buying fine china from England for $100,000 to be paid in 3 months. Right now, the exchange rate is $2 per pound, so you expect to pay $200,000. But if the pound rises by 5%, you'll need $210,000 instead. To hedge against this risk, you buy a futures contract that locks in your exchange rate today. If the pound appreciates, your futures position makes a $10,000 profit, offsetting your increased payment. If the pound depreciates, you lose on the contract, but pay less to the British manufacturer. Again, you're protected either way. That's the power of hedging. Part 4. The high-stakes world of speculation. While futures are invaluable for risk management, they also offer a dangerous temptation: speculation. That's where people trade not to protect against risk, but to profit from it. Leverage and volatility. Futures markets are attractive to speculators because you can control large quantities of commodities with small initial deposits. Margin. Price movements are amplified, meaning a small change in the market can mean large gains or losses. Example: a 5% change in the British pound's value could mean a $6,250 gain or loss. Since your initial margin might be just $2,025, you're operating with enormous leverage and enormous risk. Real risks. If the market turns against your position, you can lose your entire margin quickly. You may need to add more money to maintain your position. Losses can exceed your initial investment. This is not like buying stocks, where your loss is limited to your original purchase amount. In futures, it's possible to lose more than you invested, fast. That's why most speculators lose money. The few who win either have deep experience, follow strict risk control strategies, or often just get lucky. Part 5. The core function of futures: transfer of risk. Despite the high-octane allure of speculative gains, the true purpose of the futures market is not speculation, it's risk transfer. The core mechanism works like this. Farmers, businesses, and importers, exporters, want stability in prices they hedge. Speculators want profit opportunities. They assume the risk the hedgers want to offload. This symbiotic relationship makes the market function. The futures market exists to help producers and consumers manage price volatility, create liquidity for contracts, allow for price discovery and economic planning. Conclusion: why futures matter. Futures markets might seem complex, but they're built on common sense and human necessity. From a farmer in the 1840s to a multinational CEO today, everyone wants stability in an unstable world. Futures contracts deliver that. Yet the very leverage and flexibility that make futures so powerful also make them dangerous in the wrong hands. The key takeaway is not to fear the futures market, but to understand its purpose, its players, and its profound impact on the global economy. Chapter 27: Options. Speculation, Strategy, and the Art of Controlled Risk. Anybody who plays the market without inside information is like a man buying cows in the moonlight. Dan Drew, legendary trader. Introducing options. The right, not the obligation. When people first hear the word options in the context of investing, their minds often go foggy. Wall Street lingo makes it seem like you need a PhD in financial algebra to decode this instrument. But at its heart, an option is a contract, an agreement that gives you a right to do something in the future, but not an obligation. Imagine you're at a used car lot, and you see a beautiful vintage Ford convertible. You love it, but want to shop around. So you tell the seller, "Hold it for me until tomorrow. Here's $25. If I don't come back to buy, you keep the money. If I do, I'll pay the full price." Congratulations! You just bought an option. You didn't buy the car, you bought the right to buy it later. This is the essence of an option. A right to act in the future. No obligation to follow through. In the financial world, this concept is formalized into call options and put options tools that allow investors to profit from movement in stock prices without having to own the stocks themselves. Let's now unfold this world in detail. Part 1. Call options. The right to buy. Let's take a real-world example. You think IBM stock is poised to go up. Currently, it's trading at 120 yuan share. You want in on the action, but buying 100 shares outright would cost $12,000. That's a lot of capital. Instead, you buy an IBM March 120 call at 9. Here's how you decode that. IBM. The company. March 120. The expiration date is the third Friday of March, and the strike price is $120, the price at which you can buy the stock. Call 9. This option costs $9 per share, or $900 total, because options are sold in 100-share blocks. What did you just buy? You purchased the right, but not the obligation, to buy 100 shares of IBM at $120 anytime before the third Friday of March. You've essentially reserved 100 shares at $120. The scenarios that follow. Let's explore how this might play out. IBM goes up to $134. You buy 100 shares at $120 as equal to $12,000. Sell them at $134 is equal to $13,400. Profit, $400. Gain, minus $900. Option cost is equal to $500, minus commissions. IBM stays at $120 or falls. Your option is worthless. You lose the full $900 you paid. But you didn't lose $12,000. Your risk was capped. That's the core advantage of options. Limited loss, unlimited potential gain. Realistic strategy. Sell the option. In practice, most investors don't actually exercise the option. They sell the option contract itself in the open market, where it fluctuates in value like a stock. If the stock rises, the option rises. If IBM rises from $120 to $125, your March 120 call might rise from $9 to $13, and you can sell it for $1,300. You paid $900. Now you get $1,300. Profit is equal to $400. Commissions, $80. Net gain is equal to $320. Now you're playing with leveraged small money controlling big assets. The clock is ticking. Options expire. Options are decaying assets. They lose value over time. This is called time decay, or theta in option lingo. The closer it gets to expiration, the less hope is built into the price. If the stock hasn't moved up and the option is at the money or out of the money, its value will erode to zero. Part 2. Put options, the right to sell. What if you think IBM is about to drop? You don't own any IBM stock, but you still want to profit from its fall. Buy a put option. For example, IBM March 120 put 8. This gives you the right to sell 100 shares of IBM at $120. Until the third Friday of March, you pay $800. If IBM falls to $100, you buy 100 shares at $100 is equal to $10,000. Use your put to sell them at $120 is equal to $12,000. Profit is equal to $2,000 minus $800 is equal to $1,200 minus commissions. You never owned IBM stock, but through the put, you simulated a short position. And like calls, you could just sell the put option itself, which would have increased in price. Part 3. Advantages and risks of options. Advantages. Leverage. Small capital controls large assets. Defined loss. You can never lose more than the cost of the option. Speculation and hedging. Great for both aggressive plays and conservative protection. Risks. Time decay. Options lose value with time if the stock doesn't move enough. Volatility. Prices of options are sensitive to market swings and investor sentiment. Most options expire. Worthless. Statistically, many options lose value. Options can be thrilling, but remember, the majority of amateur traders lose money. Professionals often sell options, collecting premiums from optimistic buyers. Part 4. Key terms to remember. Strike price, the price at which the option lets you buy, call, or sell, put. Expiration date, when the option contract ends, usually the third Friday of the month. Premium, the price you pay for the option. In the money, ITM. Option has intrinsic value. Example, stock is above the strike price for calls. At the money, ATM, strike price is equal to the stock price. Out of the money, OTM. Option has no intrinsic value. Part 5. Index options and options on futures. Index options. You can also buy options on indexes like the S&P 100, OEX, or S&P 500, SPX. These do not settle in shares, they settle in cash. If the index rises above your strike price, you get the difference in cash. If not, the option expires worthless. Investors often use index put options as a form of insurance for their portfolios. Options on futures. You can even buy options on futures contracts, such as commodities like soybeans or oil. This lets you speculate on or hedge commodity prices. Just like with stocks, a call gives the right to buy a futures contract. A put gives the right to sell one. These are especially useful for hedgers and traders in agriculture, energy, or currency markets. But again, high risk, high complexity. Part 6. Moral and wisdom of options. Options are not just tools for gamblers. They are strategic financial instruments when used with knowledge, care, and discipline. But beware of the marketing hype. Low-cost, high-profit investment. Control 1,000 shares for just $500. These slogans attract the uninformed. Without knowledge, you can lose your entire capital in a blink. Final thoughts. The strategic use of options. You should learn about options not just to use them, but to recognize when someone else is using them on your behalf, especially financial advisors or fund managers. Understanding options gives you financial self-defense. Strategic offensive tools. Insight into market psychology and professional trading tactics. Before using real money, try paper trading in an option simulation. Feel the emotional weight of watching an option decay to zero or suddenly spike in value. When you're ready, start small, watch closely, and never forget. An option is a tool, not a magic wand. Chapter 28. Starting to Invest. A deep explanatory guide. 1. Investing. A personal decision, not a formula. This chapter closes the investment journey not with a finish line, but with an invitation to act. It begins with a truth often ignored in the investment world. There is no singular path. Whether you choose to manage your own money or hire someone to do it for you, the most important decision isn't what to invest in. It's who is doing the investing. You must assess yourself, your interest, temperament, knowledge, goals, and comfort level. Do you enjoy tracking the markets, researching industries, analyzing companies? Or do you prefer to delegate this responsibility and focus on your career or family? This book, therefore, was never a how-to-get-rich manual. It was a map with many trails, meant to help you identify which kind of investor you are or want to become. 2. The conservative approach, mutual funds and monitoring. Many new investors will find that the best way to start, and possibly continue, is by following the mutual fund approach outlined in earlier chapters, especially 14, 15, and 16. This method promotes diversification, stability, and ease of management. Why it works? You spread risk across multiple assets. You let professional fund managers do the hard work. You can automate your investments via dollar-cost averaging. You maintain a simple review system checking on your funds every 6 months to prune or replace underperformers. This style suits those who prefer a buy-and-hold strategy, do not wish to engage daily with market noise, want long-term compounding growth. Yet even within this conservative method, your responsibility doesn't vanish. Monitoring is vital. Investing is not set it and forget it. Like a garden, your portfolio must be weeded and watered. 3. The active approach. A craft, not a game. For those with more time, interest, and confidence, active investing offers another path. This involves buying individual stocks, timing the market, within reason, investigating specific sectors, possibly trading options or real estate. But here's the core insight. Active investing is not just a skill, it's a mindset. There's no one correct way to invest actively. Every successful investor has carved a different path through trial, error, and personal intuition. What unites them is discipline, constant learning, and emotional control. However, active investing introduces competition. You are now up against professionals, institutions, hedge funds, and algorithms. In this zero-sum game, your success may directly depend on someone else's mistake. So, how do you improve your odds? 4. Tilting the field in your favor. Play to your strengths. Invest in industries or companies where you have insider knowledge, not illegal inside information, but the kind that comes from working in a field or deeply understanding a niche. This is where your edge lies. If you're a pharmacist, you might have early insight into promising biotech products. If you're a teacher, you might foresee shifts in educational technology. Learn from the experts. The investment world is too complex to navigate alone. Books, newsletters, seminars, and associations like the American Association of Individual Investors, AAII, are invaluable. Not to copy ideas blindly, but to sharpen your thinking. Avoid what you don't understand. This cannot be overstated. Investing in unfamiliar markets is not being adventurous. It's gambling. If you can't explain why you're making a trade or buying a property in plain, simple terms, you probably shouldn't do it. 5. Is investing even right for you? This is perhaps the most profound and underappreciated question of the chapter. Some people are just not wired for investing. If you feel deep anxiety watching market swings, if following economic news bores you, or if you'd simply rather spend your energy on your primary career, it is not only okay, but wise to outsource. A professional advisor can watch the market for you, but you still must watch them. The key isn't to abdicate responsibility, it's to delegate it with oversight. 6. Foundations for a sound investment life. Let's turn to the practical wisdom the author offers, distilled into 6 core recommendations. 1. Know yourself financially. Before you invest, explore what money means to you, what your goals are, retirement, home, freedom, legacy, your values around spending, saving, and risk. For couples, this includes joint clarity. Are you financially aligned? Are you working toward shared goals? Suggested resource: Your Money or Your Life by Joe Dominguez and Vicki Robin Moore. Than just a financial book. It's a philosophy of mindful living through money awareness. 2. Get your personal finances in order. No investment can save you from bad financial habits. Ensure you live below your means. You have emergency savings. You carry adequate insurance. Your taxes are handled wisely. Suggested resource: Straight Talk on Money by Ken and Daria Dolan-Clear. Actionable advice. If overwhelmed, consider hiring a financial planner. Look for integrity, good references, and chemistry. It's a relationship, not just a service. 3. Take your time. Rushing into investing is like driving on a mountain road at night with no headlights. Especially if you've inherited money or received a windfall, take 6 months to a year just to learn. Let the money sit safely in a bank or certificate of deposit. During this time, read, attend seminars, talk to experienced investors, reflect on your financial temperament. Emotions often run high with sudden wealth. Get support if needed. 4. Practice before you play. Just as pilots train on simulators, investors can benefit from virtual investing. Many online platforms offer mock trading games. This trains you to watch price movement without the emotional weight of real money. For real estate, create hypothetical balance sheets for properties. Do walkthroughs, study costs and cash flows, even if you never buy. Prudence and simulation are powerfully instructive. 5. Start small. Real investing begins with small steps. Don't pour in large sums immediately. First, create a model portfolio. Allocate your funds conservatively. Gradually build confidence. Chapter 15's discussion of portfolio balance is essential here. 6. Be patient. Don't push the river. There's a natural rhythm to investment returns. Chasing high short-term returns often leads to disaster. Most new investors should be thrilled with 10% annual gains. Anything higher should be treated with caution. If you aim for 30–40% returns regularly, you are no longer investing, you are gambling. 7. A sample investment schedule. This book closes with a thoughtful 12-month roadmap, not as a rigid plan, but as a gentle scaffold. Here's the summarized essence. Month focus. 1. Read, reflect, talk to family, let new money rest. 2. Observe others. Start reading financial news. 3. Try newsletters. Explore areas of interest. Real estate, collectibles. 4. Continue reading, exploring newsletters. Still no investing. 5. Create paper portfolios or real estate simulations. No agents yet. 6. Play online stock games. Build confidence. 7 to 9. Start forming real portfolios. Subscribe to Morningstar. Interview advisors. 10 to 12. Begin investing modestly. Use dollar-cost averaging. Explore real estate. By year's end, you should have a functioning conservative portfolio. Know whether you want to go active or remain passive. Possibly begin exploring individual stocks or properties. 8. Constant vigilance and continued learning. Investment success doesn't come from a single good decision. It comes from consistency. Review your portfolio semi-annually. Compare individual stock picks with your mutual funds. If you've hired a professional, remain informed and involved. Always have a plan B. Markets are dynamic. Even with maps and guides, you must be ready to respond to the unexpected. 9. Final philosophical reflections. Money as life energy. The money you earn is the physical representation of the life energy you have expended to earn it. This idea reframes investment. It's not just about making money grow, it's about respecting the time, effort, and sacrifice that money represents. Wise investing is a way of extending the reach of your energy. It can give you freedom, security, opportunity, and the means to help others. Success in investing reflects traits that apply to all aspects of life: balance, patience, courage, discipline, awareness.